monthly survey data?
You gotta be kidding
Mr.
me.
Secretary,
Stop it.
Are you suggesting, we don't have to get into an argument about it, are you suggesting that when bond yields drop in a market that's worth trillions of dollars and investors place bets off the back of that economic data, that data doesn't count for anything, that data is somehow misleading?
I think that data is leading you to understand if Joe Biden was still in charge, you'd be in trouble. But you have a new president, there's a new sheriff in town, and I would bet on the economic growth that is coming from Donald Trump. You see the investments, you see it already. There's trillions of dollars of manufacturing moving to America. It's moving to America. That means the cavalry is coming. For every $1 trillion that invests in the United States of America, that produces 1% of GDP growth. Imagine that. You have a president bringing GDP growth directly to his economy. That's amazing.
Mr. Secretary, we appreciate your time and your opinion. As always, sir, the U.S. Commerce Secretary, Howard Lutnick there on the economic data, financial markets, and what's going to happen with trade. Equities are a little bit softer on the S&P. The data is a little bit weaker. We'll see if the ISM services print later on this morning confirms that weakness. And we'll go into that survey data and see what the business community says about why things are a little bit weaker, if indeed they are weaker. Then on Friday, we get a payrolls report as well. Look out for payrolls on Friday. The hard data is going to matter. The softer data is softer. Will it bleed into the hard economic data? But we need to pick up and recap what we just heard there in that interview. Some important comments. And Anne-Marie, I want to bring you into the conversation because as the Commerce Secretary was speaking, I was looking at the shares of Ford, the shares of GM, starting to pick up, starting to bounce, because we got some clarity there on what might change this afternoon.
A relief for the big three automakers, isn't it? President Trump said last night he spoke to them. Howard Lutnick said today, the Commerce Secretary, this isn't really about the tariff rate. It's about whether you're not USMCA, the trade deal between the United States, Canada, and Mexico. Are you compliant? He said he thinks those auto companies are compliant. So potentially this afternoon, the Commerce Secretary said this afternoon, we're going to get some more information. It sounds like to me that the auto companies will be getting an exemption or a carve-out starting today.
We will get that announcement, Lisa, at some point later on today. That came from the Commerce Secretary just moments ago.
It raises questions about how many companies out there are not USMCA compliant, what the ultimate goals are. He also continued to repeat that the tariffs that have been discussed so far, the 25% in Mexico and Canada, have to do with the trade war. The larger sense of where the tariffs are going, the trade renegotiation will happen on April 2nd. That's where the grand plan in terms of the tariff levels will be unveiled, so hold tight on that. This is just the drug war. At the same time, I think a lot of people are looking at, okay, well, what will it actually look like in practice for companies that need to put it into effect?
As for those companies that have reported and are twice quoted, cited in the ISM survey, they're pointing to the uncertainty around trade. Now, the Commerce Secretary is perfectly entitled to disagree with those comments and say this has nothing to do with them. But it's in the economic data. And I've said this a few times. I want this administration to succeed. I want anyone in the White House to succeed because it's for the good of the country that they are successful, that you see investment, that you see hiring. But a scorecard so far, I agree with them on one thing. We're only 5-6 weeks into this. We only have so much economic data. But the scorecard so far, the soft data, the survey data, hasn't been great. Lisa, maybe that changes in the coming weeks and months. I hope it does, but it has been softer so far.
Which is the reason why the ADP report that came in below expectations had a market move, because people are sort of attuned to this. I do wonder when they start to look at the data that comes in as Trump data, how long can it remain Biden data? And at what point is it something that is directly reflecting policies that have gone into effect or a lack of policies, but really the policy uncertainty? We don't know yet. And I agree with you. I hope that there is a strong economy, and I hope that we do not see layoffs, because that is not good for anybody. And that is the reason why I think we're all watching with bated breath.
On the data, let's get to Mike McKee for more. Good morning, Mike. What'd you see?
It's a little bit of a weird report ADP put out today, lower than anticipated at 77,000 jobs, but it's the makeup of the report that is interesting. We saw a big increase in manufacturing, 18,000 jobs, construction, 26,000 jobs. That was not what we saw in the ISM manufacturing report earlier this week. We see a loss of 28,000 jobs in education and health services, which is normally the biggest gainer in all of the categories in the non-farm payroll report. So I'm not sure how much sense this all makes. The one number that does make sense sense is a loss of 25,000 jobs in the Pacific region, which would square up with perhaps the Los Angeles fires costing us some employment. But it's going to be interesting to see now, not just what the number we get on Friday is, but where the breakdown is and how ADP matches up with that. It's going to be all about what the overall number is telling us rather than the headline number itself.
Mike McKee, thank you, sir. Let's extend the conversation. Let's talk about retailers. Chuck Graham of Gordon Haskett joins us now for more. Chuck, welcome to the program. Tariffs and big changes in the last 24 hours and no amount of certainty about the future, Chuck. I just wonder from your perspective how the likes of Target, Best Buy, the companies that fall under your coverage will make changes, if they make any changes at all, in the coming days and weeks.
I mean, Target admitted yesterday that if the prices of goods go up in Mexico, they're going to have to raise prices almost immediately. So, we'll see in the coming days and weeks. The consumer clearly is under stress over the past couple of months. We're seeing that almost across the board, whether it be Home Depot or Lowe's, whether it be Target yesterday. Even companies like Ross Stores, who have been very strong, last night had sales that were weaker. So the consumer's under a lot of stress. We're trying to unpack and double click on exactly what's going on. Certainly these headlines down in Washington aren't helping out, but the weather hasn't been good. Flu cases have been at all-time or close to 20-year highs. So there's a lot of moving parts right now.
Chuck, this raises this question. Is this sort of embedded weakness that was already set in motion, or is this due to policy uncertainty? How are you gleaning the difference between the two? And the reason why it's important is because one is backward-looking and one is forward-looking.
Well, I mean, if you go back and look at the holiday itself, it was really strong, almost across the board. So what it looks like we're seeing right now is a little bit of a hangover from the holiday, but almost unequivocally across the board, the holiday was great. So when the consumer needs to show up, they're showing up. With the lulls just look like they're deeper right now. There's really no reason to go out and shop. And then, like I said, the weather in February was really, really bad.
How much are the retailers compliant with USMCA? And I ask this because it sounds like these tariffs on Mexico and Canada will be removed for companies that are in compliance.
That's a great question. I don't know that off the top of my head. Most of my companies are domiciled in the U.S. And, the companies that have international exposure, the Costco's, Walmart's of the world, Home Depot, Lowe's to a degree, I would believe they are compliant.
Hey, Chuck, appreciate it. Chuck Graham of Gordon Haskett.
All right.
We'll get more details a little bit later on this afternoon. We heard from the Commerce Secretary about 20 minutes ago that we get that announcement, more clarity on just how big those tariffs will be. We understand they'll stay at 25%, but certain industries, certain places, those tariffs won't apply.
Yeah, meet in the middle doesn't mean 15%, doesn't necessarily mean 12.5%. It means that there will be carve-outs. That is the implication. Is it USMCA compliant? And then how do you determine that at a time when it seems like if it was in law and somebody wasn't complying, there are the tools. I mean, again, it goes down to the point of when do we get a framework that people can use to understand and preempt some of what might be coming up down the pike from Washington, D.C.
Coming up on this program, Down the Pipe, we'll be catching up with David Miracle of Goldman Sachs in just a moment to get his call on the jobs data on Friday, and we'll catch up with Mike Schumacher of Wells Fargo. We've got some major moves in this bond market. This is a really important moment for the global economy. Bond yields in America have been falling for 7 consecutive weeks. In week 8, they're a little bit higher on a week so far. Over in Europe, in Germany, yields are higher now on a 10-year by 23 basis points. The 10-year, 272. From New York, this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bell, equity futures on the S&P just turning negative on the S&P 500 following a downside surprise on the ADP report moments ago. A little bit later this morning, ISM services at 10 a.m. Eastern time. Then after that, tomorrow morning, the payrolls data. The soft data has been softer. Let's see if this really starts to creep into the hard data. Jobless claims tomorrow morning, another one to look for. Let's get you some movers going into the cash open with more. Here's Manus Cranny. Hey, Manus.
Jonathan, thank you very much. Great conversation there with Mr. Lutnick. Not our data at the moment. Have a look at this. General Motors is on the up. Compliance is everything with the US MCA. And we'll find out later on today, post that conversation, carve-out, exemption, quasi-carve-out. We'll find out the calibration of what these tariffs really look like for Canada and Mexico. Roll it over, have a look at Tesla. This is about production and politics. We know the political story in Germany. It's a backlash against Trump. A backlash against Elon Musk. Their sales fall by 76% in Germany. That is about recalibrating production in Germany, the Model Y, etc. And their sales rise by 11% in the United Kingdom. What's the Elon put? Have a think about that. I'll leave you the CrowdStrike. You might have been stuck at an airport last summer when the software didn't exactly go according to plan. That is cost dollars, $60 million, $21 million in the last quarter of the year. Well, the CEO, despite this drop by over 8% this morning, says everyone loves a comeback story. It's just not in the price this morning. John.
Manus Cranny, appreciate it, Manus. Thank you. Some of the movers going into the opening bell. Whose economic data is it? The politicians can argue over all of that. What does the data say about where we are?
Well, this I thought was interesting. We did get the ADP report coming out with 77,000 jobs. It was down from the expected 140,000, and it was the weakest going back to July. Neela Richardson, who is a friend of the show, chief economist at ADP, said our data, combined with other recent indicators, suggest hiring hesitancy among employers as they assess the economic climate ahead. Is it their data? We shall see. But right now, there's clearly a tone of uncertainty coming out of corporate C-suites.
The data speaks for itself. The politicians can argue about whose data it actually is. Markets are going to trade on the economic data as it is. And right now it's a bit softer. I would say we had a head fake last summer, particularly with employment, and unemployment starting to creep higher. We'll see if this is a head fake. See if it's just a soft patch we come out the other side of. But this is all we've got to go on so far. It's not much I know, but this is it.
And if there is certainty given on April 2nd in terms of a framework for tariffs, does that remove some of the uncertainty to allow plans to go forward and allow some of the dynamism that people have been talking about to move ahead? That is really a key question right now.
The U.S. Commerce Secretary Howard Lutnick joining Bloomberg Surveillance just moments ago, telling us that a decision on Canada and Mexico tariffs, an update on that decision, will be announced later on this afternoon. So look out for that. Joining us now is David Miracle of Goldman Sachs. David, welcome to the program, sir. Just to recap the economic data from the perspective of you and the team, where are we now and how have things changed over the past few weeks?
Yeah, I would say more has changed on the sentiment side. We begin to see some surveys come down from peak post-election optimism. I don't think we've yet seen substantial weakness on the hard data side. We did see 1 month of weaker consumer spending data in January, although I would just highlight that that follows 6 extremely strong months, and that January, because of weather effects, because of the holidays, can be a bit of a volatile month. Beyond that, I would say we're still kind of waiting to see, and we'll see a bit more on Friday, what the impact of the policy uncertainty is on both the hiring side and the capital spending side. I think that is probably the key question going forward.
This is important, David. Are you saying that if we get a weaker number on Friday for non-farm payrolls, that it could reflect the uncertainty that we keep hearing from a lot of corporate executives? Or are you saying that there was weakness already in the system that will come to fruition? And it is important what we can attribute that to.
Sure. Look, I think it's always probably a little bit excessive to draw too much from just one monthly payrolls report and attributing, where any strength or weakness came kind of to recent policies or to a couple of months back, I think would be very challenging. What I would highlight and what I think a lot of investors are focused on is that over the last couple of years, healthcare and government have played a very outsized role in hiring in the U.S., in net job growth in the U.S., and those are two industries that might be particularly exposed to some of the recent policy uncertainty. On top of that, we saw in the recent ISM manufacturing survey that companies like consumers, are very attuned to the recent policy news. There were 20 mentions of tariffs in the ISM manufacturing report. So, I wouldn't make too much of just the February report, but I think in coming months, we'll begin to see what possible effects there are of changes to tariff policy, changes to immigration policy, and changes on the fiscal side as well.
We've seen the beginning of revisions of certain analysts' expectations going forward across Wall Street. As we just heard, for example, Ed Yardeni saying that he thinks that the chance of a melt-up in stocks is a lot lower, and that he thinks that there is probably a greater chance that there could be more of a weakening in the economic data. Do you have enough information so far to adjust your estimate for the remainder of this year, or are you sticking with a call of a good deal of strength?
Yeah, well, we're looking for GDP to grow kind of close to a little. We have a forecast that's still a touch above the consensus of 2%, but I think everyone is kind of in the same ballpark, waiting to see what happens on the policy side. The last couple of years, the economy grew at a very strong pace. Part of that was because immigration and therefore labor force growth were much higher than they usually are. That's not going to be true going forward. We're going to see labor force growth, job growth, and GDP growth slow. I think everybody agrees on that. Growing somewhere in the neighborhood of potential growth at around 2% was kind of our expectation coming into the year. What we're most focused on now is trying to understand whether the tariffs that were announced recently and that we might get going forward will wind up being meaningfully larger than what we had anticipated on Inauguration Day. Like most forecasters, we had made some allowance for tariffs. Some of those have come through, like the 20% increase on imports from China. But I think that the key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated. That would probably be something that could lead us to see more downside risk to the economy. Perhaps not dramatic, but it depends on the magnitude of the tariffs.
David, what about the uncertainty? What if the uncertainty around tariffs persists for longer than you anticipate? How much damage does that do?
Yeah. This was a question that markets worried about even back in 2019 in the first trade war, and I think for a couple of reasons, the risks this time around are probably larger. For one thing, the tariffs that are being proposed are just a lot larger than what we saw last time. In fact, the tariffs that have already been implemented are considerably larger than what was in place last time. The other more subtle point is that we've found in our research that U.S. industry and Chinese industry don't overlap that much on the input side or the output side. And retaliation in the first trade war came mostly from China and was mostly directed at agriculture. I think the risks for companies from the uncertainty now are a little bit larger because obviously U.S., Canada, and Mexico do have more interlinked production chains. And if you think about some of these other proposals, the reciprocal tariff, the critical imports tariff, possible tariffs on autos or on the EU, there too, I think the exposure of U.S. companies on both the input side, the output side, and on the potential foreign retaliation side where now you need to think about what many foreign governments might do in response. All of those risks are higher, and so the uncertainty really ought to be more meaningful to U.S. companies' business decisions.
So many different variables to try and figure out. David, thank you, sir, for an update. David Miracle of the team over at Goldman Sachs on the economic side of things. Equity futures just a little bit softer, still positive on the session. Some softer data about 20 minutes ago from ADP. March 19th gets very interesting for the Federal Reserve. That two-day meeting concludes 2 weeks today. Mike McKee, our economics and policy correspondent, joins us now for more. Mike, the data is what the data is. It's all we've got. And I know we're only a month into this, but I wonder where we'll be by the time we get to that Federal Reserve meeting.
I suspect we'll be about where we are, John, given especially what Howard Lutnick was just saying about we're going to make some adjustments this afternoon, and then the real tariffs come on April 2nd. Even though the Fed has some detail now to work with about some tariffs, there's still a lot more they don't know. That's what John Williams' point was yesterday in his interview with us. He said, you know, we do know that tariffs are inflationary. We do expect inflation out of this, but we don't know how much because we don't know how long the tariffs will last, how many other tariffs will be put on, and what they're going to what costs they're going to impose on the economy. So they're not much better off, put it that way, and they won't be by the 19th than they are right now.
You were speaking, Mike, yesterday with the Fed's Williams, and it was a great conversation. It was an interesting nuance that he had about inflation and how it would affect their thinking. How much of the mainstream does he represent, and how would you characterize how this does color the path of rate cutting ahead?
Well, I think he's probably in the mainstream in the sense that what he was saying is tariffs are inflationary, but we don't know, because we don't know what the president's plans are, whether that inflation carries through. In other words, we're going to get a rise in the price level, and that's what some members of the Fed have focused on, like Chris Waller. Now, does that continue because you have a sort of rolling series of tariffs coming through, or is it that one-time price level rise that the Fed can look through? They just don't know that yet. And at the same time, they're keeping an eye on the overall economy and whether it's rolling over. The data, as we've been talking about, David Miracle was talking about, are getting softer, but the hard data, we haven't quite seen a lot of evidence on that yet. So the Fed is basically going to sit tight on March 19th and not do anything. I thought one of the interesting things we talked about, Lisa, in terms of monetary policy going forward was the summary of economic projections and the dot plot. And basically, John Williams said they're not going to mean a whole lot, just like they didn't in December, because we don't have visibility going forward.
They never do, but we produce them anyway. It's kind of frustrating, this whole thing is. Michael McKee, thank you, sir. Appreciate it. Let's check out the bond market together. Stateside versus what's happening in Germany. In America, bond yields are lower. The front end of the curve, we're down by 7 off the back of that weaker than expected economic data from about 20 minutes ago here in the United States. In Germany, we're up big, up by double digits. That divergence we're seeing, yields up in Germany, down in the United States. Mike Schumacher of Wells Fargo joins us now for more on that. Mike, it's convergence. Germany's coming up to the United States is coming down to Germany, just in terms of bond yields. How much more convergence are you and the team expecting?
Could have a fair amount, John. It's interesting. I'd say it's actually a structural shift in Germany. I know it sounds dangerous to say. People have talked about defense spending rising for years, but it's actually happening. The numbers are big, on the order of 1% of GDP incrementally for a number of years. So that's a huge change in Europe. I can imagine other countries get on board, and you see really what we think could be a massive shift as far as more issuance, higher real yields, and therefore pushing up European yields toward U.S. levels.
It's a huge change for Europe. It's a huge change for fixed income. Mike, additional issuance from a country that typically doesn't do deficit spending and celebrates the so-called black zero, balanced budgets. When the money starts to go towards Germany to finance that deficit, Mike, how do you think about where it's coming from, how the flows start to change?
Yeah, it's got so many implications, John. It's interesting. So one is ECB. ECB meets tomorrow, and for years, I and a lot of people have said the ECB is really the only game in town as far as actually easing when Europe's got a difficult time economically. Maybe that's not so much the case anymore. So maybe the ECB will get more help on the fiscal side, and it won't have to be as aggressive doing rate cuts when times are tough in Europe. That's just one aspect. You can also think about investors globally, for instance, in Japan, who would say, well, if I want to invest overseas, I have many options. I want to go to a liquid market. So U.S., Germany, France, et cetera. Maybe the UK would be candidates. Now Europe looks more appealing. So lots of nuances to the shift by the German government.
One thing that you said, Mike, was that you might see a convergence with German yields, European yields coming up to where U.S. yields are. I wonder how it affects U.S. yields and whether just developed market yields globally have to be reset a bit higher, or at least stay where they are, to absorb all of the deficit spending that we're seeing around the world.
Yeah, it's a great point, Lisa. I think there's a gravitational pull. So we haven't seen that today so much because there's just such an incredible news flow out of the U.S. as well. But if German yields go up and sustain an increase, not matching U.S. yields, but rising a bit more, and if that happens in the U.K. as well and some other markets, I do think that pulls up Treasury yields and yields in other markets that seemingly are less affected, Canada, et cetera. So yes, more issuance globally, higher real yields, that should impact all bond markets across G10 to some degree.
Mike, earlier this morning we were speaking with Bob Michael of J.P. Morgan, and he had a pretty exceptional line that he believes dollar exceptionalism peaked this week, and that you're going to start to see money flow out of the United States, and that dollar long and dollar asset long really start to get eaten away and money transferred elsewhere. Do you agree with that?
Not yet. I think that's premature. And one reason I say that, Lisa, is when you think about the depth of the capital markets here, it's extraordinary. So when we talk to clients globally at Wells, when they want to reallocate risk, they almost inevitably do to the U.S. So if there's a flight to quality, if there's a safe haven move, people will say, well, if I want to move X billion in government bond risk, I need to go to the U.S. markets because they're so deep and they're so available. I would make the same statement about U.S. equity markets. So capital market depth is something that won't change very quickly here. Could the dollar lose a bit of luster? It already has. So dollar euro is at 107. After the news last night, we think it goes up towards 110. We were bearish not too long ago, but the facts on the field have changed, so our view has changed also.
You weren't alone, that's for sure, Mike. Appreciate it. Mike Schumacher there of Wells Fargo. There were good reasons to be short. Europe, you were facing an economy that was basically stagnating, an ECB that was lost somewhere, and they can work out where they were. A German government that wasn't going to do much anytime soon, and all of a sudden, the president comes in the United States and makes a much bigger push on two fronts, I would say. A push to secure peace in Ukraine, and also a push on the trade front as well, which has developed two issues. One in Germany, more spending, and another in China, more deficit spending. They're two big shifts off the back of this change that we've seen in the White House.
There is an acceptance that maybe countries need to rely more on themselves and their local partners if there isn't necessarily going to be the same structure that they've relied upon in the past. The idea that you could have the German government, the incoming chancellor, talk about 500 billion euros of spending on infrastructure in addition to potentially a blank check for their Defense Department is massive and fundamentally shifting a lot of people's views of this market.
President Trump wanted more defense spending out of Europe. He's about to get it. Secretary Bessent wanted to see the Chinese economy rebalance. Based on her comments overnight, he's about to get that too. Euro dollar right now, 107.07, with an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. On the point of Germany, Germany will amend its constitution to unlock hundreds of billions of euros for defense and infrastructure investments. Chancellor in waiting, Friedrich Merz, has planned a 500 billion euro infrastructure fund that will invest in priorities like transportation, energy grids, and housing over 10 years. Elsewhere, Disney is cutting about 200 jobs across its ABC and entertainment TV networks. An internal memo seen by Bloomberg outlines cuts that mostly impact the ABC News division in New York, with production teams for ABC News Studios, 2020, and Nightline set to be consolidated. In its earnings last month, Disney broadcast and cable TV businesses saw a drop in revenue and profit. LeBron James made NBA history last night by becoming the first player in league history to reach 50,000 points. The 40-year-old came into last night's game against New Orleans needing just 1 point to reach the threshold. He finished the game with 34 points in a Lakers win. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. More economic data still to come. And we'll bring you some highlights from our conversation with Commerce Secretary Howard Lutnick from earlier this hour. From New York, this is Bloomberg.
the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that just empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Minutes away from the opening bell. Equity futures on the S&P 500 just about positive, softer off the back of what we saw 40 minutes ago. The economic data in America, ADP coming in weaker than expected. Lots of economic data still to come. Still to come later this morning, 10 a.m. Eastern time. Look out for ISM services at 1 p.m. a White House press briefing. Then tomorrow, another round of jobless claims plus an ECB rate decision. Friday, the big data point, payrolls Friday just around the corner, and comments from Fed Chair Jay Powell. I had a comment from the White House this afternoon. We caught up with the U.S. Commerce Secretary Howard Lutnick, telling us earlier on Bloomberg Surveillance about a potential shift in tariff policy.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle.
That last line there, somewhere in the middle. Anne-Marie joined us now from Washington, D.C. We got some more clarity, some detail on that, Anne-Marie, just what somewhere in the middle actually means.
It sounds like what it means is that if you are USMCA compliant, you will get some sort of relief today. And the Commerce Secretary Howard Lutnick saying that announcement could come as soon as this afternoon. Somewhere in the middle sounds like if you're, say, GM or Ford, and you've been on the phone with the president, as the president told us last night as a joint address to Congress, he spoke to the automakers, and you've been making the case that we have a intricate supply chain. We are USMCA compliant. This is your trade deal from Trump 1.0. You have to give us relief. It sounds like that auto sector might get that today.
And GM and Ford shares are up on the day as they do look forward to some sort of potential carve-out. Anne-Marie, I'm just curious, negotiation that a lot of people have been trying to plan for.
He said the magic word that I've been hearing from officials, whether on the record or behind the scenes. It's about reciprocity, especially when it comes to April 2nd. Now, we also got a little bit more details from the Commerce Secretary what April 2nd actually means. This could take months in terms of actually having the legal framework to enact tariffs. It sounds like when it comes to April 2nd, for some industries, for some countries and products, they might have to announce what they plan on doing, but it might take months until the actual tariffs come into place. And he said for others, it might actually be on April 2nd. So that's going to be fascinating. What tariffs actually hit on April 2nd, while others are just signposting of the tariffs that can come down the pipe.
Anne-Marie, appreciate it. Looking forward to your coverage throughout the day on Bloomberg TV. Anne-Marie Horden there of Bloomberg Surveillance down in Washington, D.C. Where do we begin this morning? I want to talk about Germany just briefly. Still seeing a 20 basis point move on a German 10-year yield. Nothing's done until it's done. Let's see if this gets through the German parliament, but certainly the potential for a major regime shift in the largest economy in Europe.
Which is the reason why German borrowing costs are surging the most. As you pointed out, since 1997, this whole idea that this is a new post-reunification Germany that has a very different kind of schedule may be pushed into it, frankly, by President Trump. And there is a question about be careful what you wish for, because is this giving people a lot of hope that actually Europe will see green shoots of growth?
There needs some insulation as well, because potentially in early April, and this takes us to the trade conversation, we'll see those reciprocal tariffs. So what we're hearing now on Mexico and Canada is different. The Commerce Secretary explained why it's different. You'll see something else in about a month from now.
It's hard to know exactly what's going to stick. If it's different than the 25% that does stick on non-USMCA compliant companies, how does that fit into the recalibration that we get on April 2nd that gives a sense of what fairness is? And we heard from Ed Yardeni earlier, he was asking, does this mean we could potentially reset to lower tariffs all around? Unclear that that could be the goal, because tariffs are going on, and that has been a goal of this president.
And we'll see how the economy responds in between. We've said this a thousand times, that the end destination could be a good one. This is the start of the journey. We've only got so much data to go on at the moment. The survey data has been softer. We'll have more data a little bit later. ISM services is going to be really important. Does it confirm or deny a recent soft patch for the U.S. economy in the service sector?
Which we saw in the manufacturing sector with prices paid also going up. In the services sector, you already have heard about the idea that there are restaurant operators that are concerned going forward. But we have seen time and again that sentiment doesn't translate into action. And if people feel bad, do they also say, well, maybe we shouldn't go out to eat tonight? I mean, this is the kind of stuff we'll find out about.
We've had a few head fakes over the last year. Let's see if this is another one. More economic data coming later this morning. Jobless claims coming tomorrow. Payrolls on Friday. Tomorrow morning, we'll catch up with Mark Giannoli of Barclays, Jill Carey-Hall of Bank of America, the former chair of the Council of Economic Advisors, Jason Furman, and Andrew Slimman of Morgan Stanley. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to a special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Defending champion Carlos Alcaraz heads into the California desert looking to make history and become just the third man to win 3 consecutive titles at the event. On the women's side, newly minted Aussie Open winner Madison Keys returns to the WTA Tour on a 12-match win streak after her victories in Adelaide and Melbourne.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator. Invest in that. Think about it. We have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever. S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
case you missed it on Bloomberg Technology.
It's incredibly aggressive, the timeline to manufacture the first phase of this site and then start production mid-2026. How big a factor was that timeline in Ohio's selection, Palmer?
It has to be this fast because we don't have time for business as usual. The types of threats that the United States is facing, that our allies around the world are facing, the fact that we are predicted to run out of munitions within the first 8 days of a potential conflict with China mean that we need to hyper-scale our manufacturing. We are on a path to being a publicly traded company. I think that's an important thing. I want us to be accessible to the American public. I think that it's good for people to be able to invest in American defense companies, not for them to just remain private forever. I'll take an ideological stand there. I think that is a good thing for the country. It's good for us. It's good for our customer. As for when that happens, it's hard to say.
Don't miss Bloomberg Technology, live every weekday.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are losing our early morning mojo as futures drop. 30 minutes till the cash trade. Welcome to a special edition of Open Interest, live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller.
I'm Katie Greifeld.
And I'm Sonali Basak, and we're gathered here again in the heart of New York's financial district. We've got executives, deal makers, investors from across the globe. And it's fascinating because where we were yesterday, guys, is a little different than where we were today, though we are headed lower, it looks like, once again, to start the day on different reasons.
Yeah, absolutely. The situation is fluid, both when it comes to the tariff picture, the economy, and these economic and financial markets as well.
I'm very focused also on what's going on in Europe. The Germans have agreed to spend an extra $500 billion, which for Germans is a ton of money and normally would break a lot of rules. And you know Germans hate breaking the rules, but they're going to do it anyway.
But it brings up that U.S. versus the rest of the world story that everyone is keeping an eye on.
Yeah, absolutely. I mean, the rest of the world tariff story is also a big focus for these markets. That's why we were rallying early this morning. Howard Lutnick on Bloomberg Television saying that by this afternoon, we should have some relief from Mexico and Canada.
And I'm eager to get to those markets, so let's go through this guest lineup because it's a big day.
Yeah, we're going to come up and speak with Tom Wagner of Knighthead Capital, Digital Bridge CEO Mark Ganzi, Shake Shack CFO Katie Fogarty, plus an interview with David Rubenstein, sitting down with former Treasury Secretary Steve Mnuchin in the next hour. And boy, am I curious to see what he thinks about what's going on.
Yeah, big time, especially after hearing from Bob Rubin yesterday, one of the highlights of yesterday's panels. Let's get to these markets because, boy, there is a lot of action. You wouldn't necessarily know it by looking at the S&P 500 unchanged in futures, which we will show, I hope. We were looking at a rally, but now that has dissolved into downside. We did hear from Howard Lutnick on Bloomberg Surveillance talking about maybe we'll get some adjustments on tariffs this afternoon, but what's driving this market, it seems to be, is that data that we got at 8:15 for February, ADP employment rather, that change coming in at 77,000 jobs. That is versus expectations of 140,000 jobs. We know that the line is fuzzy at best when it comes to ADP and NFP coming up on Friday, but at least for right now, it seems to be driving some of those growth fears that we've been worried about. You can see the 2-year Treasury yield reflecting that, down about 9 basis points.
Check out what's going on in Germany. We don't normally show you the European indexes, but the DAX is just stunning. A gain of more than 3%. And the DAX, by the way, is up 20% year to date. So handily outperforming the S&P 500.
European exceptionalism.
Yeah, really interesting for an economy that is broken. But after that announcement, obviously investors are piling in, and you can bet that they were guessing this was going to happen. The German 10-year yield up 22 basis points. That's got to be up there with the biggest gains we've ever seen in the Bund, right now trading at 271.5.
Going to come back to the U.S. Some stocks we're watching over here pre-market. Chip makers like Micron climbing after hints that the White House may ease tariffs against Canada and Mexico soon. We're going to talk about that more in just a minute. And Abercrombie & Fitch struggling to meet lofty expectations for the year despite sales sales steadily rising in recent years. This was kind of an NVIDIA level stock, the way it used to be rising. Expectations now higher. Consumers may be weaker. We'll keep an eye on consumer stocks more largely. General Motors up 5%. Car makers just like them are all moving higher. Commerce Secretary Howard Lutnick has teased relief for the sector in an announcement expected this afternoon.
Well, let's hear a little bit of what he had to say. U.S. Commerce Secretary Howard Lutnick on surveillance earlier this morning. Let's take a listen.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle.
For more on that, we're joined by Anne-Marie Horder, Bloomberg's chief political correspondent, also co-host of Surveillance. Anne-Marie, this is fascinating because these tariffs went on yesterday. And so by this afternoon, we expect some relief. Isn't that a little bit too much volatility for business leaders?
Well, potentially. The administration doesn't really see it like that, of course, because it looks like the president is in negotiating mode and he's getting concessions out of Canada and Mexico up until this moment, really. When you speak to the Commerce Secretary, Howard Lutnick, he says he's been on the calls with these officials. What we've seen Canada do in terms of the border, fentanyl czar, we've seen Mexico do, as well as potentially Mexico might be weighing whether they might put the kind of levels of the tariffs the United States has on China. They may do that as well. They're extraditing 29 individuals that are criminals with the cartel. So they're seeing a lot of progress, and potentially we could see relief for companies today. And I think the Commerce Secretary made it pretty clear, if you are USMCA compliant as a company, you might get relief today. And then, of course, I asked him, are the big three automakers, which the president in his joint address to Congress said he spoke to yesterday, he said he spoke to those executives, are those companies USMCA compliant? He says he does believe so. And that is why you saw a little bit of a relief in some of these car makers, because it looks like today they will get some relief, potentially some exemption or some sort of carve out or a lower tariff rate.
And yeah, you can definitely see that relief in shares of GM. Anne-Marie, we do have some breaking news right now, and that is that the Supreme Court has rejected Trump's U.S. foreign aid freeze. Just talk us through that. I don't know if that necessarily came up with Lutnick, but obviously that has been one of the biggest stories to follow this week.
It did not come up with the Commerce Secretary. That is really out of his purview. This would be more of a conversation with the Secretary of State, Rubio. Clearly, what we've seen the president do when it comes to U.S. aid and wanting to put those funds on a freeze, a lot of things the president is doing when it comes to DOGE and basically the firing of federal workers, all of this is going to play out in the courts. One thing that did come up with the Commerce Secretary is the April 2nd reciprocal tariffs. And we asked him if those tariffs are going to be put in place on April 2nd, or is April 2nd basically going to be the starting gun? Because I can tell you, when it comes to the legality of how to enact tariffs, it takes months. So potentially, if they enact some tariffs and they don't have enough time frames in terms of legal framework, even tariffs and trade policy could end up in the courts as well.
Anne-Marie, thank you so very much for your time. That is Anne-Marie Horder in Washington. Great interview, of course, with the Commerce Secretary. And joining us now, Knighthead Capital Management co-founder Tom Wagner, to answer all these questions around tariffs, DOGE. You know, investors are trying to shake off some of these worries when it comes to tariffs. But really what you had Howard Lutnick do is set a new target on April. How much more uncertainty does this cause, and how do you think through the risks here, particularly from an investment point of view?
Yeah, first of all, thank you for having me. I think the important issue to remember when you're analyzing how these negotiations are proceeding is first and foremost to remember that they're negotiations. And the second is to think about the timeline of your investment. If you're a trader, there's a lot going on, there's a lot of uncertainty, there's a lot of back and forth. If you're an investor and you have a long-term perspective, I think we all have a general idea as to how things will end up. And then the question is, what is the cost to your individual investment or the economy as a whole? between the start of the negotiations and the conclusion of those negotiations. I don't happen to believe that the timeline will be very long, and therefore I don't believe that the cost will be very high. And ultimately, you have to answer whether or not you believe that the final benefit is worth that cost in the interim.
It does seem like the president is getting a lot in these negotiations. I mean, if you look at what he's done with Ukraine, right, he's trying to get the Europeans to spend more, and now the Germans have announced they're going to spend $500 billion on defense. This is what he was aiming for.
Yeah, I think that's exactly what he was aiming for. I think the other thing that upset the president a little bit in Ukraine was the relative priority of repayment of the debt or the funding that had gone to Ukraine during the war, where the U.S. had taken a subordinate position, yet a leadership role in that funding. And I think that that was a fair complaint, quite honestly, particularly given the fact that for the Europeans, it was more of an existential risk. So I think readjusting that by way of the minerals deal is a huge benefit to the U.S. and, quite honestly, a fair one, given the amounts that have been paid out over the last few years. It doesn't mean that we won't see support, that we won't see the end of the war. It just means that the mechanism by which we achieve that objective will be a little bit different than what was pursued by the last administration.
Well, let's talk also about tariffs and the potential impact here on the American economy. We were just discussing with Anne Marie, because this is just something they discussed with Howard Lutnick, the idea that this injects a lot of uncertainty into, business plans, how businesses are planning their CapEx over the coming year or so. As an investor, thinking about this economy and what companies might potentially be opportunities for you, how are you viewing that landscape?
Well, I mean, selfishly, if these tariffs were going to exist for a long period of time, we'd have a very ripe investing environment, because the dislocation that it would cause would be pretty extreme. However, I don't believe, given the incentives, that the tariff structures that are being discussed today will be in place for a long period of time, if at all. I think that, again, it's the negotiation process that causes the uncertainty, and I think that's more of a trader's dilemma than it is an investor's dilemma. And so as a result, what we're focused on is, what's the end game likely to be? Will that create more opportunities? Will it create disruptions in the businesses in which we're invested? I don't believe that we're going to end up in a place where you have significant and permanent lasting disruption to the economy, because the incentives for each side to get to a deal are too high. And whenever you're faced with uncertainty in a particular negotiation, the first thing you have to think about are the incentives for each party. And in this case, in any of these bilateral trade disputes, the incentives are really high to find a solution.
I want to just jump in and point out that Claudia Sheinbaum has said that if these tariffs continue, Mexico will reach out to Canada. So it looks like they may want to team up in opposition to President Trump's tariffs, although it looks like we're going to get some relief this afternoon. I want to ask Tom about the businesses that you own. Are any of them specifically affected by tariffs? Because I think of companies that you hold that are even household names, but they're not really cross-border transactional.
Yeah, it's interesting. In the context of our holding in Hertz, I think, a rise in tariffs against imports will result in higher used car prices. That's a net benefit, at least in the short run. Again, I just don't think that we're going to see, as much as that would be a tailwind, I don't think that's likely to transpire. In some of the other private companies that we own, where they may have imports for components and parts to build their product, that would raise the cost.
Good point. Revology.
Yeah, Revology, certainly. Singer would be another potentially. However, I think the way that we're looking at it is, what's the impact on the economy? What does that do to the demand face? That's the more important element.
I really want to know your thoughts about this, because the word recession is coming up more and more. But before that, I want to go back to what Matt was saying as well. It's not just Mexico and Canada looking at a way to pair up and figure out how to get together in the face of these tariffs with the U.S., it's also Europe, right? You're looking at Europe band together in this way for defense. What I'm wondering is, do you see a scenario, given the trade flows, that Europe gets even closer to China? What kind of problem does that create for the United States?
Well, I think that some of what's going on with respect to European-China trade is causing problems for Europe itself. The European automotive industry is being significantly disadvantaged because of the lack of tariffs on Chinese imports. That's their own internal disruption. So that closeness, it gets a double-edged sword. I think we have to look at these trade disputes and understand what the driving force is behind them. In the context of China, it's largely a fentanyl-related issue. In Mexico and in Canada, it's both fentanyl, drugs, and cross-border, movement of people, right? Those are the major issues. It's not solely the economics. And I think if we were to take a step back and focus solely on the fentanyl issue for a second, if I told you that there were terrorists crossing our borders and that resulted in 2 deaths of innocent Americans per day, you would say, by God, we have to do everything possible to stop that. There would be a national uproar against it, particularly if it was totally randomized. What's happening in reality is we're losing 200 lives a day, 250,000 since 2018 of deaths to fentanyl, right? They happen to be concentrated in some of our poorest communities, so they may not always make headlines, but that's an extraordinary loss of life, vastly higher than we've suffered in human loss in all of our conflicts for the last 60 years. So when you take a step back and you look at it through that lens, I think we have to say, well, what is the greater good? Is the pursuit of some of these policies, while we may not like the negotiating style, is the pursuit of the policies for the greater good and putting an end to something that has caused so much pain. You know, for 250,000 mothers out there, these policies are the best thing that have ever happened. And so I think it's important to understand where you're coming from and what the driving force is, in addition to what the economic impacts are.
Right. Well, Tom, to your comments on fentanyl, also from Commerce Secretary Lutnick's interview with Bloomberg TV, he said that this is not a trade war, specifically with Canada and Mexico. It's a drug war. Of course, there's a lot of questions about how much fentanyl is actually coming across our northern border, but that's a different discussion. I want to go back to the U.S. economy and what you were saying about tariffs and the disruption that they might create, potential recession some folks are calling for at this point. You said that as a long-term investor, that would be an opportunity for you. And to that point, I'm wondering, do you have any dry powder at this moment that you're looking to deploy?
Yeah, there's always, you can shift the portfolio around. We don't run levered portfolios, so there's always an opportunity. We also are fortunate enough to see a lot of inflows on a monthly basis. So, you know, if it takes 6 or 9 months to hit a recession, you know, we'll have plenty of capital to deploy. I've also found that post the global financial crisis, there's always capital available. So if the opportunities present themselves, you'll be able to find the capital. And in the depths of COVID was when we raised our travel and leisure focused fund with Certares Asset Management. You know, didn't have a problem finding capital. Yeah, that was an intentional raise, and it worked quite well. So I think, you know, if we run into an opportunity set like that, the capital will be available in addition to what we have internally. So, you know, it's difficult to plan for recessions because they sort of happen because people don't expect them, not because it's, you know, it's on the horizon that you say, okay, these tariffs are going to cause a major dislocation. I think if the tariffs were starting to cause a major dislocation, it would be bilateral and the incentives would go even higher. So the pathway to finding a deal becomes even clearer. That's, you know, the prospect of a recession probably leads to an outcome that helps us avoid one.
All right, Tom, let's put a pin in this discussion. So much to get into. You're sticking with us. That is Tom Wagner. He'll be joining us next block as well. But let's get a quick check on futures here. A busy market underneath the hood, but you take a look at the benchmark level right now. We're actually a little bit higher. Of course, we erased our gains after we got that ADP print at 8:15. Now you can see we're a little bit higher, a little bit more if you take a look at the NASDAQ 100 and Big Tech up about 0.3%. The small caps hang on as well. Much more coming up. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that, have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, we are back here at the Bloomberg Invest Conference. We have a killer lineup again for you today. Shonali Basak has done a great job organizing this conference, and we're really looking forward to Steve Mnuchin at the top of the next hour. We're still with Tom Wagner, the co-founder of Knighthead Capital, and Tom, you're invested in some of my very favorite businesses, and I would say also there are a lot of Bloomberg viewers who lust over the automobiles created by Singer and by Revology, and who follow, the sports teams that you back as well, from soccer to Le Mans racing. But talk to me first about the car business, because as you said, it's one of the few that could really be affected by tariffs. When Revology is building these Mustangs, they need the motors, they need the transmissions, and they need steel, which is looking at tariffs on March 14th.
Yeah, I think that, in the context of these cars, you have to take a step back and recognize the demand is vastly in excess of the available supply. That was one of the key components of our getting involved. And what's driving that is our view, as the world digitizes and electrifies in vehicles, you see an increase in interest in cars that inspire some level of passion. We've talked about this kind of thing in the past, and that's resulted in people really falling in love with the restoration of old Mustangs or old Porsches. And the reason is the experience is so analog and visceral, right? You get into a car, it feels different, it smells different, it drives different. It's likely a vehicle that you fell in love with as a kid and then ultimately lusted after as an adult. And I think that, we look at that, we see a very rosy outlook for the forward demand of these things. And I think we're all in on being, forever involved in those situations. So, that's how we look at the demand phase for those products. And I think it's less of a tariff issue and more of what's the quality of the product that you can deliver. And that's beyond simply what you're constructing, and it goes into, the overall feeling of what you're providing to the consumer.
As a car guy, people always play this game, like if you could have 3 cars, if you could have your perfect car garage, what would be in it? And I always include a Singer in there because they're such special vehicles. I mean, they're really like works of art. I would rather have that than a Rothko, for example.
Right.
But they're, $1.5, $2 million to get into, so I'm still saving up. But is the market still there? I mean, on the high end, in the luxury market, is the demand still strong in this economy?
For sure. It absolutely is. And I think the same is true for Revology, which is a slightly lower price point in the $200,000 to $400,000 range, depending on how you option the vehicle.
Mine would be 4.
And yeah, exactly. But the reason for that is these become lifetime purchases, right? And my brother was talking with me yesterday about the idea of a dead man car, which is a great Jerry Seinfeld quote. You buy the car from a guy that is dead, and you won't sell it until you're dead. They're things you intend to own your whole life. And I think cars from Revology and Singer fit that bill perfectly. These are things that folks really want to have and hold and experience for their whole life.
Okay, I get the mic now. We're off of cars. We're on to my love.
We can continue showing the video of Singer though.
Or Tom Brady and the Raiders, which is where I want to go next. Okay, so I'm a reporter of the people. When Tom Brady took a stake alongside you and others for the Raiders, one question I had, it's interesting to see a former player get a stake. Do you see a scenario in which you have players asking for equity?
Yeah, that is not going to happen in the NFL, specifically because it's not allowed. at least under current rules. And I think that the reason for that is it really begins to complicate the salary cap issue. And so for the integrity of the game, I think the commissioner, Roger Goodell, and the owners have done a very good job in helping to ensure that pay is pay, and it's quantified under very, very clear terms. When you start offering equity, there's a question around valuation, there's a question around terms and control. And so I think that upholding the sanctity of the game is a really important component of it. What makes Tom's involvement so special is that he had the wherewithal to buy a meaningful piece of the team because he's been highly successful and he's done a good job of building up, a substantial net worth. The more important element is that Tom is very involved, right, and will, provide his insight into best practices. And I think that's, a really enormous value add. We've certainly seen that firsthand in Birmingham City in what he's been able to do. And I think the Raiders have the benefit of additionally having folks like Egon and Mike Meldman involved who will really drive the excellence on the business side. So it's a multifaceted story in the Raiders, and I'm super excited just to be around those people because they have so much to offer.
It's so interesting, Katie. I was talking to Rob Gronkowski soon after that deal was done, and it was such an inspiration. You have now more and more former players wanting to pull another Tom Brady is what's been going on.
But not with the money that Tom Brady has.
Well, or the partners, right?
Yeah. There you go. So football is just one of the sports that's in your sports investing portfolio. So I want to talk to you as an investor in this space. I can't imagine that you're bringing your distressed investing playbook to the sports world. So how do you evaluate potential investments that you might make? What factors are you actually looking at there?
In every case in sport investing, at least as it relates to how we look at that sector, is a question of whether or not we can drive an increase in commercial revenues, right? The aggregate revenue of the franchise or team or club needs to be increased. And when we looked at the assets that we've made and the purchase we made, that was the key focus. Birmingham City, it was all about, can we grow commercial revenue? And the reason in Birmingham City that was important is that when you look at the teams that are going from the championship into the Prem, the top 8 teams on average are receiving payments from the Premier League in parachute payments to make up for them having been relegated. There's 16 other teams that don't receive parachute payments. The teams that have that additional revenue are 4 times more likely to get promoted to the Prem. And so you have to cross the £50 million mark in total revenues to fall into that zone where you can say, okay, now I'm on equal footing from a revenue perspective. So when we bought the club, we was doing just over £19 million in turnover.
Right.
To next year on a projected basis, if we're lucky enough to get back into the championship, we'll do north of £50 million. And that's a huge adjustment in a very short period of time that makes us highly competitive. So that was an example of where we've been able to do it. If I flip it and look at in racing, where we just got involved in Legacy Motor Club with Jimmy Johnson, that was another one where we had a really strong view on Jimmy's commercial attractiveness and what we could do with the team and our view of what would happen with NASCAR in sort of a changing environment, cultural environment in the U.S. And we have a strong view that we'll see a significant increase in commercial revenue there as well.
All right, Tom, we have to take a commercial break. Pleased to say that you're joining us when we get back. We'll take you through the market open next. And it looks like futures back in the red when it comes to the S&P 500. It's been a volatile morning. We're just about unchanged. They had to do me dirty there, but tech holding on to its move, as is the bond market. The open is up next. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf. There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we are moments away from the start of trading. This is a special edition of Open Interest. We are doing it live from Shanali's Bloomberg Invest Conference down here in Lower Manhattan. I'm Matt Miller alongside Katie Greifeld and Shanali Bastick. We've seen futures swinging back and forth between gains and losses. They were firmly solid this morning when Howard Lutnick went on at least a couple of business news networks and said, we're thinking about giving Mexico and Canada some tariff relief 24 hours after putting tariffs on them. But then they fell after we got the ADP numbers. Of course, we're waiting for that all-important non-farm payrolls read on Friday. Very key to the Fed. And I guess really that was enough to outweigh the tariff relief concerns, at least for a moment. We'll see what happens throughout the day. We have the bonds back at 420. You've got big gains in European stocks and big gains in European yields as well. But look at this, Katie, not a lot of actual action.
No, but it's misleading, right? Because we know there's been a lot of volatility this morning, and we're coming off of 2 straight days of pretty heavy-duty losses when it comes to the S&P 500, when it comes to the NASDAQ 100 and the Russell as well. So at least for right now, a little bit of a sigh of relief. Small moves overall. We know a lot can happen between now and 4 p.m., so we'll keep an eye on this market. But let's take a look under the hood, because that's where the action is. We're taking a look at car makers, including GM, moving higher this morning after Commerce Secretary Howard Lutnick teased some relief for the sector. An announcement might come this afternoon. You can see these stocks rising in anticipation. Stellantis leading the way, up over 6%, Shanali.
I'm looking at Foot Locker, Katie, because it anticipates a tough first half of the year due to budget-conscious shoppers. Abercrombie and Fitch announced a $1.3 billion buyback. And so you do see the stocks diverging here, 12% up on Foot Locker, 12% down on Abercrombie. The growth was not enough to excite Wall Street. Remember, this was a stock on a tear last year. There are generally concerns about the consumer. It's interesting to see how investors are navigating in that.
Yeah, absolutely. Usually when you buy back more than $1 billion of your stock, you see a green arrow there. So this is a big decimation for Abercrombie stock. Taking a look at chip stocks after Lutnick signaled there may be tariff relief following talks with Canada and Mexico. I still think it's so strange to see them in the green. I was looking at Intel. They were also trading positive in the pre-market after Donald Trump yesterday gave his State of the Nation, non-State of the Nation speech to the joint session of Congress. He said, essentially, we're not going to give them any more money from the CHIPS Act.
Exactly. He said that essentially he would like to do away with the CHIPS Act. We know that's funneled billions and billions of dollars to Intel. So
about $50 billion to the industry, but it's brought in $400 billion in investment. So
yeah, a lot of moving pieces here, but I don't know. You can see Micron trying to decide what to do. Let's broaden out, though, and get back to Knighthead Capital's Tom Wagner. I'm pleased to say he's still with us, and we're going to get back to sports. Just a fair warning there. But there's an interesting note out from JP Morgan this morning showing that market implied probabilities of an economic downturn has climbed to about 31%. We were talking about this about a half an hour ago, basically, that you will have capital available should opportunities arise. And I'm just wondering what sectors, what industries you're keeping an eye on right now.
I think the one that we're the biggest chunk of our capital is flowing right now is in the market to serve the data center and AI community. We're developing a large project in Pennsylvania that will take what was a coal-fired power plant and decommission that, which has already been done. It will tear it down and build new generation to serve the data center community broadly defined, which a substantial component of, if not all of, will go for AI compute. And I think it's a great example of taking an asset that doesn't work in today's economy for a variety of reasons and transitioning it to something that is maybe the hottest sector in the market. And so we're excited about it. You know, we'll have a mix of generation fuels and capacity. We've got some really exciting forward-looking opportunities on the nuclear front. And so there's a lot that's happening there, you know, generally speaking. And I think we're really thrilled, you know, to be leading that.
Oh, you know that I get jazzed about data center math. I could go on about it, but I do want to ask instead about AI, the opportunity, what it's going to do to the economy. Is it more likely to create a huge dent in the job market or more likely to amplify productivity to the point that you see real economic gains?
I mean, I've got some kind of kooky views on this, generally speaking. You know, when we look at technological innovation, and we've seen an extraordinary amount of it in the last 100 years, it hasn't resulted in mass unemployment, right? In fact, we find ourselves at the point of highest technological innovation in human history, and we have in many economies a shortage of skilled workers. So I think that, you know, technology has a way of empowering workers and providing newer opportunities. To the extent that AI becomes extraordinarily disruptive, so long as we have an economy that is sort of working in the context of how it's worked over the last couple hundred years in a modern capitalist society, what we may do is create more free time for people. And you know, we may move to 4-day work weeks. We may have, you know, more free time and see an economy that begins to transition.
You're getting my hopes up, by the way.
Yeah, well, if it transitions to one where there's more leisure activity, that's certainly good for some of the things that we talked about. It's good for Matt's pursuit of his passions in autos and motorcycles. But I also think that it's a positive for the overall human existence, right? As long as we have something that's fulfilling for a substantial component of the week so we can get satisfaction out of being productive, I think it's quite reasonable to expect that we have more free time. And that's really, if you talk to a lot of the futurists that are more optimistic on the deployment of AI, I think that's where they'll tend to, and I fall into that camp personally.
That would be more babies, right? That would change the demographics.
Babies, more robots.
With more free time, we could have more babies and, you know, I could go see the Isle of Man TT.
Yes.
I could go see Le Mans.
Right.
The population
I do want to get back just quickly to sports because it seems like you have such a great international view, at least in this sector, right? We were talking during the break about your we were talking in the last block about your investments in cricket and talking about, you know, the motorcycle racing, talking about Le Mans, where you own Jota. And I know we have some fantastic footage of those cars. It's incredible. But how do you get this international view here? And do you invest in all of this stuff with Tom Brady? Is he always your sports betting partner?
I mean, we want Tom to be involved in all of our sports properties because he's so additive. He's definitely involved in our Le Mans team. He's got his name on the side of the car. You know, you should honestly, Le Mans is one of these great sporting events that is unknown to a lot of people in the U.S., or at least they're not enormously familiar with it beyond, say, Ford versus Ferrari and that wonderful movie that came out a few years ago. I would highly encourage you to do a show from Le Mans. It's one of the most attended sporting events in the world. It's this incredible 24-hour race. It's got extraordinary uncertainty of outcome. You have no idea who's going to win the race until the very end, and it's actually a really exciting time. So, you know, it's a good excuse to be in France in the middle of June.
I'll do it.
I think the bosses might be listening.
Yeah, do a Thursday show during the practice sessions. It would be a lot of fun, and we'd be happy to host you. We've got a great facility with our partner Cadillac and Jota and Hertz, who are all, you know, heavily involved there. So, you know, look, I think that our involvement in these assets are because we see an opportunity. You know, in Le Mans racing, it was a very, very, very low entry point, but one where we believed that the excitement of the race was generally, you know, misunderstood in a lot of the global sport viewing community. And we thought that we could bring that market to people and help increase that attractiveness over time.
Tom, we got to leave it there. We thank you so much for joining us. Of course, crazy market out there. And of course, investors still looking for direction. That is Nighthead Capital's Tom Wagner. And let's hope his 4-day work week thing sticks, guys.
Let's all go to Le Mans. Let's do our show from there.
That's
right?
another great idea.
Yeah.
Lots to work with here.
Now, I'm heading out to go back to Invest Day 2. We are going to have Steve Mnuchin at the top of the next hour. But coming up next, Digital Bridge CEO Mark Ganzi is going to talk to this show about AI infrastructure opportunity in the United States. Get his view here, guys, on that data center map. I don't even believe it. Let's see what he has to say. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
The issue of ending the war in Ukraine must be, I believe, the victory for Trump and not for Putin. Putin is nobody for him. America is way stronger and Europe is way stronger. China is way stronger than Russia. They are all players.
We are exploring ways for Argentina to be able to open up to international trade. And why? Because the division of labor brings prosperity. Adam Smith said so. And 250 years later, that holds true. Adam Smith is still right.
I would like taxes to be lower on people and on businesses, but I'm not going to play fast and loose with the public finances, because in the end, you actually don't result in anyone being better off, because it sends interest rates soaring.
I think everybody has welcomed the ceasefire in Gaza, but it's only first step. We hope that it will be a starting point for solving genuinely the Palestinian problem.
Nobody covers Davos like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg. All right, welcome back to a special edition of Open Interest live from Bloomberg Invest in downtown Manhattan. You take a look at stocks right now, actually catching a bit of a bid. The S&P 500 up by about 0.4%. The NASDAQ 100 not too far behind. Same story if you take a look at the Russell 2000. Of course, we're coming off of 2 straight days of a pretty brutal sell-off, so a bit of a bounce back right now as we count down to NFP, that jobs data coming on Friday. We had a pretty ugly reading of ADP private employment this morning, but the line fuzzy at best. Meanwhile, let's shift gears and talk about data centers, because Digital Bridge is helping build out the infrastructure needed to power artificial intelligence from data centers and cell towers to fiber networks and more. CEO Mark Ganzi joins us now on set. Great to see you in person.
Thanks, Katie. Good to be here.
So you were telling us before the segment started that you've been investing in this space since 2014. There's a lot of folks now involved who maybe didn't have it on the radar about a decade ago. So just tell us how the industry has changed, how the competitive landscape has changed as you're trying to identify opportunities.
Well, if you look back to the advent of public cloud back in 2011, there was probably in total less than 1 gigawatt of compute power powering data centers around the United States today. Contrast that to today, we're at about 18 gigawatts. And depending on whose prediction you believe, we're going somewhere between 130 gigawatts. Masa-san said 2 weeks ago at a conference, 300 gigawatts. Kind of hard to extrapolate who's going to be right and who's going to be wrong. I don't think we need to make that bet today. But what we do need to understand is that capacity is at least going to grow by 10x over the next decade. And that really confronts the industry with a lot of challenges.
Well, talk to us about the DeepSeek of it all, because you think back to DeepSeek Monday, and it really raised this existential question of whether this build-out, this AI build-out has been extravagant. Maybe it didn't need to be as robust as it has been. Would love to hear your thoughts.
Well, look, my thoughts is it's a history lesson, right? If you go back when we were building, I've been building infrastructure for 31 years. So I built mobile towers in 1994. I connected New York City with high-speed internet in 1998. And for me, this is just another tectonic shift, Katie, in technology. We started with the internet. We moved then to mobile data. We moved to public cloud, and now we're moving to AI. These are decade, generational investment ideas. These are not investment ideas that happen sort of quickly and overnight. Now think about as we adapted to the internet and we adapted to mobile phones and to public cloud. Guess what happened along that adaptation curve? Costs went down. And so what you're seeing with DeepSeek is that you don't need to build a large language model to be in the business of supplying AI and supplying generative AI. And I think DeepSeek was, for us, it was really a point on the inflection curve where we see costs coming down for developers and application writers. But ultimately, the infrastructure behind that, remember, was provided by Meta in terms of their open source code. And to build that LLM model for Meta took years and billions of dollars of capital that enabled DeepSeek to get where it is. Innovation is going to happen. Innovation happened in public cloud. Innovations happen in mobile data with respect to mobile networks. And so as you see adaptation move up on a J-curve, you see costs come down. This is really Jaron's paradox. And if we think about that in the context of framing 30 years of investment in digital infrastructure, DeepSeek for us is a logical progression, not something that we should be alarmed about. And in fact, since the announcement of DeepSeek, we've had 4 of our customers come back and say they're increasing CapEx. Meta, Apple, look at what Alibaba just said last week, $58 billion in new data center CapEx spent around the world. So our customers today, Katie, are spending more money on infrastructure, not less.
It's funny, first of all, I covered the 3G auctions as a young Cub reporter, so I've been right there with you along the way. And in this current technological revolution, you see a lot more profit than you did back then. And you see a lot more immediate use cases than you did back then. But I was hearing about AI from you, I think, for the first time on a Microsoft Teams call, and you were telling me about how much power these things need. Regardless of the cost, we still need that power. How are you getting it for your data centers?
So I think, power is really the long pole in the tent right now for data centers. And I think we've taken a very pragmatic approach, Matt, which is there's going to be situations where we're partnered up with the grid operators, which are traditionally the publicly traded utility companies. And there's going to be situations, Matt, where we go off-grid, where we're building our own solution set. So we started building microgrids about 2 years ago. We've done that in 2 locations, one in Reno, Nevada, and we built 2 microgrids, believe it or not, in, of all places, Tambor, Brazil, where we're operating 1.3 gigawatts of power, and it's all hydro. We own our own microgrid. We've leased our own transmission infrastructure. And when we couldn't get the right answer from the utility company about getting power, we took that problem in our own hands and we solved it. So I think part of this is you're going to have solutions that are on-grid solutions. You're going to need solutions that are off-grid solutions. And by the way, we need the full arsenal of power, Matt. You need coal fire, you need LNG, we need solar, we need wind, we need hydro. We need everything that we can throw at it because the amount of power that's coming is just massive.
By the way, Mark, everything looks full speed ahead, right? Your assets under management have quadrupled, quintupled in the last 5 years. Except for yesterday, the president said he wants to stop the CHIPS Act and slow down the money that's flowing out to these all-important semiconductor producers in the U.S. Does that make sense to you, and does that kind of throw a wrench in our plans?
Well, I don't think it throws a wrench in the plans. I think what the president is signaling is he wants to put America first. And I think he wants to bring manufacturing and jobs back here to this country. And look, whether you're on the red side or the blue side of the aisle, that's a purple issue. I think we all want more jobs and we all want
That's
more.
what the CHIPS Act was for, right?
It was, yes.
That's the whole point of it.
And so we don't see a shortage in chips today. I do believe you got to look around corners and you got to think about what's coming next. We do see a shortage in GPUs over time. I think that is something that has to work itself out. But ultimately, the amount of capacity that's going into data centers today is well understood for the next 3 years. It's where do we get to, Matt, in 28, 29, and 30, and where are the next generation chips going to come from? Are they going to be built here? Are they going to be built in Asia? Where are they going to be built? My bet is some of them are going to be built here, but don't sleep on Asia. Asia will build a lot of GPUs, a lot of chips. Look at what ARM's doing and the ambition that Masa has.
Right.
Those chips won't be built in the U.S. Some will be built in the U.S. Some will be built in Japan. So I think you have to take the long view on semiconductors. You have to take the long view on chips. And I personally am long-term on GPUs and chips.
All right, Mark, unfortunately, we have to leave it there. Hope to continue this conversation
Anytime.
soon. Really interesting. That is DigitalBridge CEO Mark Ganzi. Meanwhile, let's get a check on these markets. We're about 19 minutes into the U.S. trading day. You can see the S&P 500 still kind of deciding what to do. Currently higher by about 0.1%. We know that we've seen a lot of pain over the past 2 days, a lot of questions around the will he, won't he. Okay, he did when it comes to tariffs, but maybe they'll roll back a bit. All of that volatility coming through in these equity markets. Similar story in the NASDAQ 100, now down about 0.1%. The small caps actually holding in here. The Russell 2000 up about 0.2%. I want to quickly look at the bond market, though, because you saw that ADP figure come in very light this morning for the month of February, and we're waiting to see what we get in the U.S. jobs report on Friday. Hopefully we'll show the 2-year yield, but you take a look at the
There
curve.
you go.
There we
Prayers
go.
answered, Katie.
I actually got the 2-year yield. I also have the 10 and the 30-year yield, and you can see the curve. A lot of the buying coming in at the short end. 2-year Treasury yields down about 8 basis points. Of course, we know that traders are now pricing in more cuts this year than they were just a couple of weeks ago. I believe it was 3 cuts priced in for 2025 last I checked, and you're seeing that expressed in the 2-year yield. The 10-year yield, not down as much when it comes to the actual yield, but still down about 5 basis points.
Can I just say,
here.
we
Yes,
saw,
you can.
I mean, speaking of yields, not necessarily American, we saw the bunds jump 25 basis
You're
points.
taking us to Germany.
Well, I just think it's a fascinating story, right? Germany has historically underspent in terms of defense, right? We haven't always wanted Germany to rebuild their military.
This is true. This is true.
And now they're rearming. Maybe problematically, just as the far right starts to gain a huge amount of the vote, but nonetheless, they're going to spend $500 billion on defense. You see a 25 basis point jump in the bunds, and that's the biggest jump we've seen in those bonds since 1990 when reunification happened. So it's kind of a big deal.
Kind of a big deal. Big deal in the German bond market. Big deals happening in the U.S. bond market. Bob Rubin telling us that yields are going down for the wrong reason, Matt. There's a lot of concerns about the economy and also the consumer.
Yeah, absolutely. How do I make this shift?
I did it for you.
The consumer.
Yes.
The consumer. I got it. Okay, let's focus in on the consumer. Not necessarily borrowing money to go to Shake Shack, although I do love those smoke shacks, the double. CFO Katie Fogarty is here with us on set at the Bloomberg Invest Conference. Katie, great to see you again.
Great to be here.
I did a special
You
edition
told
of
me.
Chief Future Officer with Katie, which was amazing. That's the first time I tried the smoke shack, and now I'm addicted. You don't need anyone to take out a loan. Nonetheless, the consumer health, I guess, is key to your business. How's it look from your position?
We reported an exceptional fourth quarter, and it really has been a story that we have been executing against, a strategy that we've been executing against for many years now, of leaning into our strategies around marketing, driving sales through culinary innovation, and improving our operations to continue to drive a better guest experience. And that really, our approach to the fine casual sector has really helped us to navigate what others are seeing in the consumer backdrop. So, we talked about this a couple weeks ago, but, the first quarter has started off a little bit shaky for a lot of other restaurant competitors. What we saw in January was exceptionally strong at, 4% comp. just being able to navigate here against the challenges that others are seeing.
Katie, I'm a little bit obsessed with the bird flu, a little bit worried about it as well. Your CEO recently said that the egg shortage that we're seeing as a result of the avian flu is spurring demand, could spur demand for chicken and beef. I understand that Shake Shack is less exposed to egg prices because you don't offer breakfast, but walk me through the tie-in here. When it comes to beef prices rising more quickly than chicken prices, that surprised me a little bit. You would think that chicken would also be, actual chicken meat would also be sort of in a short demand right now.
There's a lot of interesting cross currents that are happening in the commodity market right now. You know, chicken has a little bit of has a much shorter growth cycle than beef does. And some of the pressures that, you know, we and the rest of the industry are seeing on the beef side, those are just going to take longer to navigate, just given the growth cycle for the herd versus chickens. But we're really, you know, fortunate that we have the supply chain team that we have in place and that we're able to navigate these challenges, you know, to the best of our ability.
I'm really curious about your supply chain. And when you have shocks like this, I mean, there's some, as you mentioned, idiosyncrasies going on when it comes to cattle, obviously chicken, the nation's chicken supply in a funky place with the bird flu. Can you hedge it all when you're buying beef, when you're buying chicken? What does that look like on your end?
Sure. So a lot of different restaurant companies approach this in different ways. We use a very specific product for our, you know, ingredients. We, you know, being in the fine casual sector, we use elevated premium, you know, kind of the stuff that traditional fast food does not use. That includes no hormone, no antibiotic chicken. Our beef is premium, all Angus. And so that means that we can't really go to the open market and kind of hedge the things like our traditional peers will do. That doesn't mean that we don't have strategies to help navigate the cost, but when we have elevated inflation in various parts of the supply chain, for the most part on beef, we just don't hedge that given the very premium product that we source.
Katie, are you concerned about tariffs? President Trump tweeted about reciprocal tariffs maybe helping out U.S. farmers in the longer run, but we know that a lot of our beef, a lot of our produce here is imported, and those companies may face tariffs as well.
So we're watching this just like everybody else is. We are very fortunate to be in the situation where we source all of our beef domestically. And a lot of our supply chain, not just on the beef side, and also our restaurant equipment, are things that we make in the USA. So, you know, that does insulate us from a lot of this noise. But at the same time, our supply chain team, I mean, we just celebrated our 20th anniversary of being a company, our 10th anniversary of being a public company. And we have built very deep relationships with our suppliers. And, you know, it's just very critical in this moment to have that network to help navigate through all of these changes.
All right, very cool to see you again. Thanks so much for
you.
joining us. Katie Fogarty there. She's the Chief Financial Officer over at Shake Shack. I recommend going back and watching our episode of Chief
I will, you
Future
know, I was
Officer.
just thinking I need to go watch that.
And then maybe we go to Shake Shack for lunch.
Right.
Coming up next, former Treasury Secretary Steve Mnuchin is going to join us. Well, he's going to be sitting down actually with David Rubenstein here at the Bloomberg Invest Conference. Very fascinating to hear what he has to say. Could be a little different than what we heard from Bob Rubin yesterday.
Yeah, really looking forward to that conversation coming up next on this program. Don't go anywhere. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Peter King. President Trump describes his first weeks back in the Oval Office this way.
It has been nothing but swift and unrelenting action to usher in the greatest and most successful era in the history of our country.
A CBS News poll shows Republicans mostly loved his congressional speech. Democrats, not so much. CBS's Margaret Brennan says those in the room felt it was long on hyperbole and short on substance.
It did feel like a campaign rally. What stood out to me was the anger in the room, the thin attendance by Democrats, and the lack of explanation for any of these policy promises.
Wall Street's reaction has been mixed, but right now the Dow is up 252 and the NASDAQ is up 62. Vice President Vance is headed to the southern border to reiterate the administration's stance on illegal immigration. Boston's Michelle Wu is among several mayors testifying at a House hearing on sanctuary cities. That hearing just getting started.
We're a city that opens our arms and offers a hand when this administration is more interested in turning its back. I will never back down from an opportunity to defend Boston.
In a 5-4 decision, the Supreme Court has just declined the Trump administration's request to stop a lower court order that required it to pay out roughly $2 billion in foreign aid money to USAID and State Department contractors. The president responds favorably to a conciliatory social media post by Ukraine's President Zelensky. National Security Advisor Mike Waltz on CBS Mornings.
Frankly, we wish that had been the tone, tenor, and substance in the Oval Office on Friday, and we would be talking about having an already signed minerals deal, binding our economies together.
Waltz says he expects the U.S., Ukraine, and Russia to be back to negotiating an end to the war soon. CBS's Vicki Barker is at the foreign desk with the latest on Pope Francis.
The Pope's condition is said to be stable as he continues to battle double pneumonia and a complex lung condition. Pope Francis hasn't been seen in public since he entered the Rome hospital hospital nearly 3 weeks ago, and celebrations for the start of Lent are taking place without him.
The line of storms that ripped through parts of the Deep South yesterday has moved east after leaving 2 people dead in Mississippi and heavy damage there in Texas and Oklahoma. Some of those high winds made it to Louisiana. This man lives in Gramercy, which is between New Orleans and Baton Rouge, and he says he's pretty sure a tornado blew past his house.
I saw it coming, and next thing you heard, we walk inside, and I tell my fiance, I was like, hit the floor. And next thing you know, it blows my daughter's window out.
This is CBS News. A South Florida school is reporting a case of measles. It's not known if the patient is a student or staff member. Another first for a future basketball Hall of Famer.
Not just any three-point shot in the first quarter of an NBA game. LeBron James, the NBA's all-time leading scorer, topped the 50,000-point mark on ESPN in a win by the Lakers over New Orleans in L.A. The 40-year-old star finished with 34 points. New teammate Luka Doncic said, "It's amazing watching him do this stuff at his age." Steve Kathan, CBS News.
When Honolulu police bought a robot dog with COVID relief money, they said it would be invaluable in many situations. Well, Spot was used 100 times in 2021, but local news reports say it hasn't been used since then. The department is trying to figure out what to do with him. Peter King, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Invest 2025 conference down here in Lower Manhattan. We're at this Bloomberg conference. We're bringing together the leaders of global Wall Street. We're going to dip into some panels that are taking place here today. We have some great guests on site as well. Coming up, we're going to check in with Katie Fogarty. She is the Chief Financial Officer at Shake Shack. She's joining us live here at this conference. And we're also going to dip into this panel. Stephen Mnuchin, founder and managing partner of Liberty Strategic Capital and former Treasury Secretary, is sitting down with David Rubenstein. We'll get some thoughts there. So we got a lot coming up in the next 2 hours from Bloomberg Invest 2025 in Lower Manhattan. Right now, let's go to John Tucker and get a Bloomberg Business Flash. John, what do you got for us?
All right, guys, this Bloomberg Business Flash being brought to you by IBKR. With a year-over-year change in the U.S. PPI exceeds 3% in February 2025. At IBKR forecast trader, the yes was recently at 39%. What's your take? Trade your prediction at ibkr.com/forecast. Equities right now getting a bit of a lift after the latest data. This is from the ISM Services Index, the biggest part of the economy, coming in at 53.5. The expectation was for 52.5, so a beat there. Remember, anything over 50, that is expansion. Now, as far as the services prices paid index, that also is coming higher than expectations at 62.6. The expectation was 60.4. Right now, the S&P 500, 19 points higher. That's up 0.4% at 57.98. The Dow Jones Industrial Average up 208 points, and the Nasdaq 100 right now is 79 points higher. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Now, Alex Steele, Paul Sweeney at the Bloomberg Invest Conference.
All right, JT, thank you so much. We really appreciate it. We do want to take you right now to a panel here at Bloomberg Invest. Steve Mnuchin, founder and managing partner at Liberty Strategic Capital, former Treasury Secretary, of course, as well, is joined by David Rubenstein, co-founder and co-chairman of the Carlyle Group. Let's listen in.
25% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP, and that's got to be a major focus. So if we're going to do the tax cuts, we need to make sure there's pay-fors, and we need to make sure there's economic growth.
When Bob Rubin was Secretary of the Treasury, he once talked about the value of the dollar, and he made a mistake, he later would say, by talking about saying something other than we want a strong dollar. And now every Treasury Secretary is told you can only say one thing about the dollar. We want a strong dollar. But what can former Secretaries of Treasury say about that? Can they say we want a strong dollar, or can you say maybe it should weaken a little bit and to make our exports easier to sell?
Well, you know, it's funny that you say that. And Bob really was kind of credited with the strong dollar policy. And I think it's kind of every Treasury Secretary after that kind of, you know, you got Treasury 101 training, and the first thing they told you was just talk about a strong dollar. You know, actually, when I was at Davos, I made a comment that I commented on a balanced, stable dollar as opposed to saying a strong dollar. And all of a sudden, the dollar moved significantly. Look, I think, and now I can talk a little bit more freely about this, but I think on the long term, it is important that we have a strong dollar. The dollar is the reserve currency of the world, and a strong dollar reflects a strong economy. In the short term, particularly because of trade, you know, the strength of the dollar can have a negative impact. But I think the most important thing is actually a stable dollar so that there's not volatility.
Speaking of stable, what do you think about the Secretary of Treasury or the U.S. government supporting cryptocurrencies? They didn't really have them so much when you were Secretary of Treasury, but now cryptocurrencies seem to be very heavily supported by President Trump and his administration. Do you have any comment on whether that's a good or bad thing?
Look, my view on crypto has been pretty consistent. We did a lot of work on this in the first term. If people want to buy crypto as an asset class, like they buy gold, that's fine. I personally wouldn't invest in it, but that's fine. To me, the bigger issue has been making sure that crypto is not used for illicit activities. And, you know, we spent a long time getting rid of Swiss numbered banking accounts, making sure that we have a mechanism that crypto can be compliant with BSA and all of our money laundering regulations. And I have concerns today about that.
You know, in the business world, investment world, if you hire more fundraisers, you usually raise more money. In the IRS world, if you get more agents, you usually raise more money. But for some reason, the Republican Party seems to want to have fewer agents, and therefore they reduce the number of agents, and therefore maybe they're not going to raise as much money. Do you have a view on whether cutting back the IRS agents that were put in under President Biden is a good thing to do or not?
Well, I have a strong view on this. I spent a lot of time overseeing the IRS. I mean, the reason why Biden administration added so many agents, this is the silly part of government math. So if they added all these agents, they were able to score it that they were going to able to raise revenue in the future, and they spent that revenue today. So I actually don't think we need more agents. What we need is a bigger investment in technology in the IRS. The systems are outdated. And I think in this day and age, there's a lot we can do with technology that we don't need physical agents auditing people. It can be done electronically.
Now, is it possible for the Doge people to get the individual tax returns of a particular person who they might not like, or that's pretty impossible to do?
Well, it's not allowed. So people are not allowed to get individual taxpayer information. My understanding is that they can get access to anonymized information. Again, I think it would be helpful for Doge to help look at modernizing the technology, but obviously, you know, looking at specific taxpayer information should not be allowed and isn't allowed.
Okay. Now, President Trump and his administration are very focused on the trade deficit, which is very, very high these days. But is the trade deficit that big a problem compared to the budget deficit? If you were to worry about which deficit, wouldn't be budget deficit be more important than the trade deficit?
Well, as you said, we have what's called the twin deficits. Right. In my opinion, the budget deficit at $2 trillion annually is a much bigger problem. And I think, by the way, if you brought down the budget deficit, by definition, you'd bring down the trade deficit because you'd have less demand for goods in general. And I do think the idea of resetting trade relationships, I mean, President Trump is right that the U.S. market has been open for foreign trade, and foreign markets have not been open in the same way. You know, we spent a lot of time with China on the phase 1 deal. They haven't lived up to that. But the whole idea was, if we could allow access, our business, to a growing China middle class, that's an enormous opportunity for U.S. business. And I do think kind of a big part of the trade deficit is we don't have fair trade in both directions.
Now, President Trump has made it.
All right, that was Steve Mnuchin, founder and managing partner, Liberty Strategic Capital, former Treasury Secretary. Speaking with David Rubenstein, co-founder and co-chairman of the Carlyle Group here at our Bloomberg Invest conference. Joining us now at the conference on site is Katie Fogarty, Chief Financial Officer of Shake Shack. Katie, thanks so much for joining us here. Love to get a sense of, everybody's talking about tariffs and what it might do to economic growth, what it might do to the consumer. Who is the consumer at Shake Shack, and what is that consumer telling you these days?
Great. So, you know, who we think of as our consumer, we have, you know, went out there and we have this amazing real estate strategy. And what we've done is we've put these great community gathering places in a lot of these, you know, great communities. And where we have attracted is just really kind of more of a, I would say, you know, more a middle income to higher income guest. And we've seen that guest be able to weather a lot more of the economic headwinds than other, you know, than the low income consumer has been facing. And, you know, what we continue to see is by leaning into our strength, which is delivering a fine casual experience. So we think about kind of bringing all those great guts of fine dining, elevated food, premium ingredients, doing the things that, you know, other, you know, fast casual and QSR just are not willing to do, putting that in an amazing hospitable environment and getting great guest service. That together has been a winning formula to help us outpunch what has been, you know, some consumer headwinds that has been facing the industry. And we are going to continue to lean into that. It's helping us to differentiate and kind of pull apart from the pack. And it's been our strength.
Where are our samples?
I know.
I mean, what is this about? You know, who doesn't want a burger at 10 a.m. on a Wednesday?
We're close to open. So.
Okay. So who are your competitors then?
Yeah.
So if you're a middle and high-end consumer, who would you say is a competitor?
Yeah, I mean, we sell burgers, shakes, fries. I think the best chicken sandwich out there in the business. We view our competitors as being, you know, anybody who, you know, you might consider having lunch at or dinner at. So that is a pretty wide array, and it also can be, you know, food at home. I mean, that can also be, an area where you would have some share of stomach. So, you know, for the vast amount of, of our restaurants out there, we are competing with a lot of people. Now, we are differentiated, and we are kind of in that category of one in the fine casual sector. But at the same time, we know that, you know, people have lots of different options where they can go out to eat.
Katie, there's a lot of concern out there about inflation. If inflation were to come into your business, where would you see it, and how do you plan for that?
So we actually have been navigating through inflationary pressures for a number of years here, and doing so quite successfully. I'll say, you know, we've had wage inflationary pressures. In COVID, it was actually very hard to get restaurant talent in our restaurants to staff and to deliver our food. It was not a desirable job at the time, and we raised wages and had a very competitive and compelling opportunity for our team members. We also introduced tips as a way to compensate our team members as well and give them added benefit. And then last year with California Fast Food Wage Act, we faced through that as well. We've also had on the food side, inflationary pressures that we've been navigating for a number of years as well. But through all of this, through leaning in on our strength, which is, again, delivering that elevated, experience to guests, giving them that, $25, black truffle burger that we are actually selling for $10 and giving them that great value on that side, we've been able to both grow sales and grow margins at a faster pace. Just even last year, we expanded our margins in the fourth quarter by 300 basis points.
So I've never had Shake Shack, but I know, but it looks like I may be able to now on Delta.
Yes.
So, and this really also goes to your expansion plan. So Delta's going to offer Shake Shack burgers on additional domestic routes this year, and that could expand international flights next year. Talk about these expansion kind of plans.
Yeah, I mean, if you look at Delta at its core and what this does, this is an opportunity where we're able to surprise and delight our guests, give them that thing that they weren't really expecting. You have your expectation for what airline food is like, and this opportunity to get a Shake Shack burger and our great, we have a special brownie that we've made for Delta as well through this program. People are just absolutely elated at the opportunity to have that on their flights. And so much so that it's exceeded our internal expectations. We're rolling it out to more airports. You're going to be able to get it, New York, Atlanta, a number of airports, and that will just, probably continue to grow. And, if you look at that opportunity, and I can make so many different parallels to how we've gone into an area where the consumer had a certain expectation, and we just really raised the bar on it and outpunched above our weight and transformed what people were expecting from, it's airline food, if it's roadside food, and across the board.
Katie, in terms of growth, how many locations do you have today, and what's your outlook for the next year or two?
Yeah, we have, across both our company-operated and our licensed business, we're, about 550, 570 locations, but we are growing very fast. We're going to add another 45 domestic company-operated Shacks this year, and we're going to open about 35 to 40 licensed Shacks as well. Those licensed Shacks are ones that we operate, that our partners operate. We have locations in the U.S., but most of that is kind of outside of the U.S. in Asia, and we have UK, the Middle East, Mexico, and most recently we opened up in Canada.
Well, great stuff. We really appreciate it. We know you got to run, Katie. Thank you very much. Next Time Snacks, Katie Fogarty, Chief Financial Officer at Shake Shack, looking at that stock. It's been hit with a lot of consumer stocks, though, this year, down by about 23%. All right, let's get you caught up with a Bloomberg Business Flash. For that, we go back to headquarters and Tucker.
Yes, holding down the fort at headquarters, as it were. We are data dependent, so we'll get to the data in just a second. I should tell you, we are being brought to you by this Business Flash, being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This for new U.S. customers with the minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The Institute for Supply Management's gauge of services, now remember, this is the biggest part of the economy, advancing to 53.5 in February, and that exceeded economists' expectations, also signaling growth. Remember, 50 is the dividing line between contraction and growth. Also, more evidence of weakness in the labor market. We got those figures earlier today. This is from ADP, showing hiring at U.S. companies slowing in the month of February to the lowest pace since July. And the U.S. Commerce Secretary telling Bloomberg President Donald Trump set to announce maybe changes to the tariffs on Canada and Mexico. So that glimmer of optimism sent, among other stocks, automakers higher. GM, for instance, right now, up 4.1%. Meantime, you have to go back to the first Trump administration to gauge the impact of tariffs overall. At least that's according to Christina Hooper at Invesco.
When tariff wars were in their full bloom, we had the stock market down, we had volatility up, so we're likely to see a somewhat similar pattern this time. Of course, it should be dulled if we see some rollback in the tariffs.
And Abercrombie and Fitch is struggling to meet investors' lofty expectations. The retailer saying revenue this year will grow 3 to 5%, but investors wanted more. Abercrombie shares right now down close to 16%. And you can wash down that bologna with vodka seltzer. Kraft Heinz, the ketchup and bologna seller, rolling out its first alcohol product for grocery stores, unveiling a new hard seltzer, vodka refreshers. S&P 500 right now down 6 points. The NASDAQ 100 again has turned lower, right now down 58 points. The Dow's up 70 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, JT, thank you so much. We appreciate that. Grade 1 through grade 8, my mother made me bologna and cheese sandwiches basically every day.
I love it. Was bologna and mayo for
Was
me.
it?
A little
Okay.
bit American cheese. Yeah. Not with
Like a
vodka.
JT.
No, that came in high school.
Yeah, that came in high school. All right, John Tucker, thank you so much. Alex Steele, Paul Sweeney live here in our Bloomberg Invest conference at Brookfield Place in Lower Manhattan. Lots of great guests we're just grabbing. As soon as they get off the stage, we grab them and put them in the hot seat. One of them is Chris Heisey, Chief Investment Officer at Bank of America Private Bank and Merrill. I love that branding right there. Somebody thought of that. You paid that for that. Chris, talk to us about the market here. There's a lot of crosswinds coming in, aside from some of the economic data like we received today, aside from some of the corporate earnings that we have to deal with. A lot of crosswinds coming out of Washington, D.C. How do you guys at the portfolio level deal with that?
Well, novel statement here I'm about to say, which is, market hates uncertainty.
Yep.
We've seen it. There's a lot of uncertainty. It's across the board. It's geopolitical risk. It's policy in general. It's now starting to seep into the level of growth. You saw a little bit of soft patch data. We believe it's a little exaggerated, frankly, because a lot of it was weather-induced. I know it sounds like an excuse, but it's particularly true in the Northeast.
Yep.
But when you're putting all of this together, one thing that hasn't changed is the fact that corporate earnings are still going to be very attractive and above average, frankly. You could see double digits. Some of Wall Street has been bringing them down, but that's pretty natural. So overall, we're in a volatility pothole, which is forcing some repricing. And that's very healthy. And it's easy for me to say because it's only a 5% pullback, and it could get to a 10% correction, but that would be a buying opportunity in our opinion.
So the narrative of maybe you want to be putting money into areas that will be stimulative, Europe, for example, Germany, most likely China versus U.S. Hold water for you?
It does. It's at the top of our watch list for one very important reason. They are now serious about a level of stimulus. It wasn't the case before.
Both of them, you can make the argument, right?
Both.
Yeah.
That's right. And when the U.S. was providing the fiscal stimulus, you saw what happened. Now, granted, it created a deficit for sure, but now you're starting to see easing financial conditions across Europe. At the same time, you're seeing this willingness now to add fiscal spend to get the growth. So it's a little bit of a normalization. I wouldn't get too overly enthusiastic about non-dollar assets, but certainly at the top of the watch list to upgrade.
Just breaking across the Bloomberg terminal right now, red headline, Canada won't end tariffs unless all U.S. tariffs lifted. That is according to an official. So again, the news keeps flowing here. So as we think about the U.S. equity markets, one of the risks that gets called out quite frequently, Chris, is just this concentration risk. It's just too over-concentrated, some of these big cap names. As you talk to your portfolio managers, how do they deal with that?
Most portfolio managers cannot own up to the level of what the index is in any one name. So when people say portfolio managers are underperforming or active managers are underperforming, well, they can't participate at the level that the index can. Now, we're now switching into a marketplace that's rotating, rebalancing. I like to use the word rebalancing because the rotation would make you think that it's going to happen with a snap of a chalk line. It's from here to there. It
also implies that you'd be like selling tech and buying Europe. Like it's a one-for-one.
Exactly. And I think it's just really portfolio construction, to your point about what do you do with it. I think you have to look for three things that have been driving markets, and it's now switching to other parts. It's earnings momentum, price momentum, and news momentum. Those three things hit together. Where are they hitting? Some defensives and, frankly, some cyclicals. And away from the big leaders, I wouldn't be short the big leaders, though.
So if you're not short the big leaders, how do you protect yourself from all the noise?
It's very hard to do. You have to take emotion out. You have to be disciplined. How do you be disciplined? You have to have a process. You have to have cash ready to reinvest and stick to your goals. I know that sounds very simple and elementary, but it's the only way to create a framework that takes the emotion out. Granted, we just wrote a report recently. It talks about focus on the trend lines, not the headlines. Hard to do. So to a certain degree, trust your instincts about your goals and objectives and be diversified. And it just doesn't always mean 60-40. It's whatever that appropriate mix is for you.
What are we doing in the fixed income world here, Chris? We got yields coming down, actually.
Yeah, for a few people that have been around the block a little bit, we're back to the 1990s again. Okay. And you're talking about 4 to 5% yields, which are attractive for savers and fixed income investors. So there's a reason why fixed income is called fixed income. And that's how we should think about it versus the total return that occurred for better part of 3 decades. So we're looking across the curve. We're right on duration right now. We think at some point up to 5% of the 10-year yield, it's important to extend duration a little bit. A lot of people don't like to do that because they're getting 4% at the short end. That's fine. At the end of the day, I would say in terms of segments within fixed income real quickly, we want to be neutral across the board. There's not a unit of risk out there that's going to give you extra return that is more attractive than any of the space.
What about corporate credit, for example? Because we finally start to see a little bit of a widening in the investment grade market.
In addition to international equities being at the top of the watch list, it's also corporate credit. They're at spreads now. They're a little bit more attractive, both high yield and investment grade, and I would consider that an upgrade potential.
So one of the topics we hear a lot about at this conference and a lot of conferences over the last couple of years is alternative investments, not just private credit, private equity and hedge funds, but also private credit. How do you and your private clients at B of A Merrill, how do you guys think about that?
Well, we think of it as an alternative piece of credit, right? And at the same time, right now, where it is in the cycle, stay high quality. Don't reach for the lower quality end of private credit right now, even though you're going to get a little bit of pickup in yield. You can do that in the normal high yield market. We don't see any big default cycle coming. We're kind of through the hornet's nest of that recycle of going from 0% interest rates sharply up to 5%. So we look at private credit as an alternative source of credit as a part of a build out of a portfolio on the private side.
Okay, so if we were looking at the 60-40, or like, just don't think of it like that. Is it what percent is equities, what is fixed income, and in fixed income, what would be your traditional stuff versus a private credit?
So you start with the role it's going to play. Okay. If you're looking for it to be in a yield or a yield enhancing strategy for you, that comes from fixed income. If you're going to pick up a little bit of the equity, which some parts of private credit can do, then it's a little bit of a combination of both. We don't have any one particular allocation to private credit. It kind of depends on the individual. But at the end of the day, I think you're going to consistently see this. It's gone from an asset class that basically had nothing in it to $2 trillion. Ultimately, they're probably increasing that over the course of the next decade for sure. So we're going to constantly be adding to it.
We talked a little bit about Europe earlier. There's actually been some pretty good performance out of Europe in this first quarter vis-a-vis the U.S., and that has not been the case for a long time. Does that change your allocation? I mean, do you risk kind of chasing this performance?
The U.S. reached 70% of the world market cap. Extraordinary. I remember in the 1990s, it barely broke the 52% level, and everybody got excited. Now you're talking 70%, and it makes sense for everything that's going on in the last 20-plus years. We think it's a little excessive. We don't believe that America dominance from an equity market standpoint is over, but we think people should reassess their allocation overseas and not in overseas investing. Typically, the window opens and it closes. And usually it closes because they can't compete on growth, they can't compete on yields, and ultimately the dollar doesn't stay weak. It ultimately strengthens again. You're starting to see winds of change there. So this is a great time to reassess and put that at the top of your watch list for a potential upgrade.
And I'm assuming you're talking about the fiscal break kind of coming off the boil in Germany. So like this time it maybe actually is different.
It seems
famous last words, right?
It seems like that. And there's a lot of investors who think the international markets didn't participate in that narrow leadership. They did. A lot of the companies that led the market, even now in this year, particularly in Europe, they get most of their revenues outside of Europe. They just happen to be domiciled there. But you're going to pick up value. And it doesn't mean you go from growth to value. You have a broad mix of both.
How about back here in the U.S. valuation? What's the valuation call here? Earnings have been good, but are they good enough?
This is where it gets interesting, right? The whole second derivative argument is slowing down, and the first mover, when the second derivative is going up, higher velocity, get higher earnings growth, you start early, you benefit from that. Now you start to see a little cresting of that second derivative. You're slowing down, but earnings growth should still be okay. Our view is pretty simple. Valuation, if billions of investors feel comfortable paying 20 times forward earnings, who are we to argue with that? Until something changes. What's that something? We have to see earnings growth fade and ultimately go down to almost 0, 3, 2%, keeping with inflation. We don't see that. So we are comfortable with valuation right now. We understand it's at premium, but our last point on this is pretty simple. If the leaders have been, and the leaders of tomorrow are going to consistently be asset light, they have high cash rich, they have good balance sheets, they have low fixed labor, why shouldn't they have premium valuations? And that's how we see the market moving in the next 10 years. It's going to become increasingly asset light, which keeps valuations a little higher than what we've come to know in the last 30, 40 years.
Before we let you go, thoughts and comments on a potential recession in the U.S. What are you guys modeling right now?
Very low level. Obviously, if tariffs stay and they stick and they're across the board and ultimately it becomes a tax on growth, we would have to reset.
And stay and stick means like forever tariffs.
Forever tariffs, at least, or if they just stay and stick through the year and into next year, it could harm growth pretty aggressively. So we'll be watching that closely, but we have a very low probability on any recession risk in the foreseeable future.
Villanova basketball, tough loss at Georgetown last night, 18-13 on the year. What's going on down in Philly?
I don't even want to talk about last night. Let's talk about humble and hungry, which is who we are, and we're going to move on, and we're going to do really well.
Are they having a hard time adjusting to the nil and transfer portfolio kind of thing?
Everybody is.
Right.
Yeah, it's a whole new state out there. But at the end of the day, it is what it is. We like friendly competition. We're going to look forward to the Big East. It's going to be very, very fun. And Big East is back.
Big East is back. Rick Pitino's back. See, I snuck in a little. The Villanova people, they're very passionate about their hoops.
Hey, man, I support sports. I support you supporting sports.
My father was all set to go to Villanova.
Yes.
And then the Japanese bombed Pearl Harbor.
Oh,
Changing
wow.
plans for him and like a lot of people. So soft spot in the heart for
Yeah, fair enough, fair enough.
Chris Heisey, thanks so much for joining us. Chris Heisey, Chief Investment Officer, Bank of America Private Bank and Merrill, here at our Bloomberg Invest Conference. A lot of smart people running around here.
Yeah, it's really great, actually. I mean, all these people that you see through the screens, and now they're real, and you're talking, and you get lots of time to chat. Coming up, we will do just that with Yep Kim, a Chief Investment Officer at Texas Municipal Retirement System. So they manage about 40 billion plus pensions in today's very complex system. So lots to get through. Like, how do you find the return? Where do you do that? Where does private credit land, and how fully funded are you? Plus the different rules of whether for a pension in Texas versus, say, in New York. We will break all of that down for you. Take a look at the market. After yesterday, this feels like a little calm breath. Volume is light. Equity is going absolutely nowhere on that stronger services data. This is Bloomberg Intelligence live from the Bloomberg Invest Conference.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, the latest data did not disappoint. February services ISM, that measures the biggest part of the U.S. economy, came in above expectations. The major stock averages right now, they are higher in the S&P 500. We had 6 of the 11 major industry groups higher, being led by material stocks. The worst performing individual stock in the index, that belongs to CrowdStrike. And those shares, they were down over 10%. The VIX right around 24. And despite tariff turmoil, Bob Michael at JP Morgan Investment says we can avoid recession.
The Fed has done a really good job of taking us into a soft landing. I think they're going to pull it off. I think we're going to get yields to stabilize here. Maybe the front end come down a little bit. The Fed still feels uncomfortable that they're too far away from their neutral rate. I think there are a couple more cuts coming.
Apple updating its MacBook Air laptops and Mac Studio desktops with new processors, cameras, and features. They say the new MacBook Air is going to start at $999. S&P 500 right now, 9 points higher. That's up 0.2%, 5786 on the index. The Dow Jones Industrial Average is up 146 points. That's a rise of 0.3%. Right now, the NASDAQ 100 is up 0.1%. That is a 24-point increase. 2-year yield, 5 basis points lower. Right now at 393. The 10-year yield is unchanged at 424. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Bloomberg Invest Conference in downtown Manhattan. We talk to all the top names in business, really. Asset managers, private credit, private equity, even pension funds. And for that, we are joined now by Yup Kim, a Chief Investment Officer at Texas Municipal Retirement System, managing $40+ billion in pension fund today. You have a long history in funds, right? You previously ran private equity over at CalPERS. You also were senior portfolio manager at the Alaska Permanent Fund Corporation. So you've been through this for a long time. Mm-hmm. What is the best allocation that you can think of right now in this very strange, difficult environment?
Yeah, it's, I think on a very holistic basis, we are long-term investors. And so our long-term strategy remains unchanged. It's really predicated upon 3 pillars. Number 1, attract, hire, and retain the best talent possible, and also attract and partner with the world-class investment managers around the globe. Secondly, it's really about taking a low-cost public markets, benchmark-aligned approach to investing. I do think we all recognize going forward there are more alpha opportunities, and beta might be, there might be some headwinds to beta going forward. So I do think increasing the share of active management in public markets will be a critical approach. And lastly, really endeavoring to generate a lot of the outperformance going forward in private markets will be absolutely critical. And and so I do think kind of with the confluence of a lot of market volatility, it's easy to be swayed left and right. But I do think kind of sticking to your core long-term strategy is very important in this environment.
How does an asset allocation work for you guys down in Austin? Mm-hmm. Stocks, bonds, alternatives. What role do alternatives play?
Absolutely. Look, I think when you think about alternatives, the delta between a median manager and a top 5 percentile manager in alternatives and privates can be upwards of 1,500 to 1,800 basis points. That equivalent number in public markets is 250 to 300 basis points. And so you are really compensated for good manager selection, but also good deal selection. Mm-hmm. And so I do think there's still, when you think about the next 10 years, there's a lot of equity value creation that will occur in the private markets. And so it really, kind of provides that long-term, kind of alpha engine to the overall portfolio.
I mean, it's no surprise that you did private equity in your last job, and then now you're taking over the Texas Pension Fund.
Correct.
How well funded are pensions right now?
Yes, and so pension funds are definitely better funded, kind of really on the backs of 2 incredible years in the equity public markets, and I do think public pensions typically have higher allocations to public equities, and that's certainly helped. At Texas, we're above 90% funded, and so and just given that we serve cities that are growing, our net cash outflow for the past 2 years has been less than 1%, and so that really empowers us to harvest, the illiquid premia of our private markets book, but also really helps us risk manage on the liquidity side.
How do you feel about just the opportunities today? Where do you guys see the best opportunities?
Sure. I think maybe 3 things I'll share there is, number one, the core building blocks on why people were excited about this U.S. exceptionalism, the core building blocks have not changed, right? When I talk to my peers in Asia and Europe and the Middle East, the U.S. continues to be the top destination, for their investment capital. You have the top academic institutions, in the United States, presumably, with the greatest founders, the most tenured management teams. You have access to cheap energy. You have really a risk-taking culture that's celebrated. That's really not found in many parts of the world. And so I do think when we think, the question we ask is not how do we generate outperformance in 2025, but how do we generate outperformance in the next decade? And we do view the U.S. to continue to take an asymmetric share of that equity, value creation in our total portfolio.
How do you deal with liquidity when it comes to different parts of the market? Being in the public market, obviously, it's easier, but then the more you go to alternatives, the harder does it get?
Yeah, absolutely. Liquidity is absolutely critical. I do think, as I shared before, given that our net cash outflow annually is less than 1%, we're very well covered by our public equities book and our public credit book to meet those annual, liability streams. The situation you really want to avoid is having to sell your private market assets at a grave discount, right, to satisfy that liability stream. And so we feel very, very fortunate, from a liquidity standpoint.
Texans would say that they are unique. They are Texans first. Really strong belief in that. And that oftentimes comes into the investment themes as well, kind of leading the way with maybe an alternative view of ESG investing several years ago, allocating towards energy versus people who don't allocate towards energy. How does that impact running the state pension fund?
Yeah, look, I think Austin is a wonderful place to be an allocator, right? Yeah. There are a number of very large LPs, in town, and all the CIOs we convene together, and we share kind of our views of the world, and so I think that's super helpful. I think thematically we're really excited about 5 big mega trends, right? Number one, obviously around digital transformation. So we're talking about just industry transforming AI applications, vertical software, cybersecurity, and data centers. In healthcare innovation, we're really focused on next generation preclinical biotech platforms, and also just opportunities across the biotech and pharma value chain. On industrial resilience, really around robotics, AI, and also aerospace and defense. And then kind of the last 2 areas is really around energy modernization and financial empowerment. So opportunities in fintech and also asset light insurance brokerage. And so look, I do think the next 15 years will look very different from the last 15. And so really digging deep on these mega trends and understanding how the world is moving, how these industries are transforming will be critical to long-term outperformance.
Here's an entirely unfair question you have to answer now in 30 seconds.
Okay.
Do you think the U.S. should have a sovereign wealth fund?
I do think that I do think we have the best investment talent in the world residing here in the United States. I do think a lot of our federal sources of capital has not been compounding at endowment or pension-like returns, and so I think there is great opportunity to bring the best of America's investment management and apply it to different forms of federal funds.
All right, great stuff. I really appreciate it. They're getting some thoughts on these markets. Yep, Kim, Chief Investment Officer, Texas Municipal Retirement System, based in Austin, Texas. Great town, great town.
I've never been to Austin.
Yeah, as a sell-side analyst, you go there a lot because it's a big state, which means they have big pension monies, which means they have the ability to pay big trading commissions to Wall Street. So you're always down in Austin. East Lansing, Michigan, you get the idea.
I'm a Houston gal because
I know,
the oil stuff.
I know.
So speaking of, I'll be there next week. But never to Houston, never to Austin. I feel
keep
like
Austin weird.
Be a thing. Yeah, keep Austin weird. All right, coming up, we're going to break down some of the economic data from today, the ISM services, as well as a disappointing ADP. This is Bloomberg Intelligence.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from a Bloomberg Invest 2025 conference in downtown Manhattan. A lot of the action, though, is still in the economic data, in particular ADP. We also got ISM services and also what's going to happen with trade policy. Earlier today, U.S. Commerce Secretary Howard Lutnick spoke with Bloomberg saying there may be a potential shift in tariff policy.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle.
All right, that was Howard Lutnick. We also are hearing from Peter Navarro on CNN talking about trade as well, saying Trump is right. There are going to be some kind of tariff disturbance, and all of this just means a little bit more uncertainty within the market. Michael McKee, Bloomberg economic and policy correspondent, joins us now. Mike, is that uncertainty showing up in some of the data?
Not yet. Interestingly enough, we've had divergent data today. The ADP report comes in a little light in terms of private sector jobs, and the composition of jobs is a little strange in that report. But the ISM services PMI comes in much better than anticipated, and new orders were up, which is the converse of what we saw in the ISM manufacturing number. So a little reassurance for the markets, which sort of have been bouncing around today, but in general have taken a little encouragement from the idea that perhaps the economy is not falling off a cliff.
Hey, Mike, I see the ISM services prices paid came in higher than expected and higher than last period. Does that suggest maybe some inflation seeping in to the economy there?
Well, maybe more inflation still in the economy as opposed to seeping in. Now, It's a little hard to separate out because we don't know. This is a sentiment survey, and we don't know how much that sentiment might have been influenced by all the tariff talk, but tariffs generally don't hit services in the same way they hit goods. And so this may be just more a reflection of the cost of raw materials, maybe commodities that are out there now. We don't know, but we have seen the ISM services prices paid index up for 4 months in a row. So it does seem that we still have some inflation out there the Fed's going to have to address.
Yes, inflation address. And that brings us to your news-making interview yesterday with New York Fed President John Williams talking about how to address the inflationary impact from tariffs. Can walk us through some of the highlights here, because that was definitely one of the standouts yesterday at Bloomberg Invest.
Well, the Fed's been waiting for quite some time to have any kind of comment on what Trump's policies would be, because he didn't know what they were. But now that we know he's got these 25% tariffs on, maybe some carve-outs coming this afternoon, and more coming, as Secretary Lutnick emphasized over and over again this morning, the Fed feels a little more unconstrained. John Williams talking about the fact that tariffs are inflationary. Now, they don't know how inflationary, because they don't know how many tariffs are going to end up being imposed at what level and over what period of time. But he did suggest that that's reason for caution, and that the Fed basically needs to stay on hold for right now.
We're going to get some labor data, Mike, over the next couple of days, with initial jobless claims tomorrow and then non-farm payrolls on Friday. Still too early to see any effects of DOGE impacting the numbers?
Well, we might actually get some numbers this week, because the federal government employees have their own category within jobless claims. It's funded separately. And so it's 2 weeks delayed in terms of its release, and should suggest that we are now at least getting some jobless claims from federal workers who've been laid off. So we would anticipate that. I wouldn't anticipate much, if anything, showing up in the payrolls report on Friday, because that encompasses the pay period that includes the 12th of the month. And it really was Valentine's Day, February 14th, when the layoffs really started. If you remember the late night Valentine from Elon Musk to so many federal workers.
Mike, before we let you go, my favorite question, As most of you know, he always likes to send me charts in the afternoon, like the one nerdy thing that Mike's paying attention to. What's that one nerdy thing you're going to be paying attention to?
Well, I'm looking at the ADP numbers, and it's unusual that we see service industry jobs much lower than the goods-producing jobs. In this case, it's the goods-producing that's very odd, because we've been talking about how manufacturing is suffering, and yet they had a big increase in jobs during the month, according to ADP, of 18,000 jobs, and construction was up by 26,000. But what have we been hearing for weeks now about how bad the weather was, and how do you have a lot of construction going on when the weather is that bad? So some unusual numbers. Also, education and health services is usually the biggest job creator, and ADP found a 28,000 job loss there. So I'm not sure about the makeup of the ADP numbers, but we'll get a better clue on Friday.
All right, Mike, thanks a lot. Really appreciate it. Michael McKee, Bloomberg Economic and Policy Correspondent, joining us now, looking for his nerdy chart later on as well. All right, for our listeners in the U.S., here's a reminder that you can listen to us via satellite radio on Sirius XM, channel 121, across the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle, and you can stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now, and we have a big hour lined up for you. We still have a lot of great guests here at Bloomberg Invest. We will break down with Steve Meyer, New York City Retirement Systems Asset Management CIO and Deputy Comptroller, talk about funding issues and how do you wind up allocating will be huge. Plus, we're going to dip into some of the great panels that are lined up right now. As Joseph Bay is co-CEO over KKR. We'll bring you that conversation.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
So everybody, Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are bringing you all the top news in business, economics, and finance now today through our Bloomberg Invest 2025 lens. We are in downtown Manhattan, going through amazing guests throughout the next hour. We're going to be speaking to Steve Meyer, New York City Retirement Systems Asset Manager, CIO, and Deputy Comptroller on site. Also, Purnmia Puri, governing partner and senior portfolio manager for public credit over at HPS Investment Partners. So we're going to get real deep on that kind of asset class investing. Plus, we'll be dipping into some of the great panels here with co-CEO over at KKR, Joseph Bay, with our moderator, Shali Bassett, who's really been spearheading this conference as well. But let's kick it all off for you with a Bloomberg Business Flash with John Tyner.
All right, guys, the major stock averages right now mixed to little change. Not a lot of enthusiasm today. Right now, the data getting the attention for now, as Mike was saying, the Institute for Supply Management reports non-manufacturing. More growth there. The service industry employment and customer orders both accelerated for the month of February. And then earlier, we had kind of conflicting data from the payroll provider ADP. That signaled a slowdown in small business hiring with tariffs and elevated volatility. David Lebovitz at JP Morgan says, you know what, investors need some better direction.
I think more clarity on the direction of travel, right? A more narrow dispersion of outcomes is what the market is really looking for, because effectively what's going on here is you're seeing this slowing in growth at a time where policy uncertainty is rising. And that's very difficult for markets to digest, hence the volatility that we've seen over the past couple of days.
The S&P 500, 6 points lower right now, down 0.1%, 57.72 on the index. The Dow is up 63 points. The NASDAQ 100, 30 points lower. And he mentioned VIX, the volatility index right now, that is elevated to 23.56. Novo Nordisk, following in Eli Lilly's footsteps, they're going to sell their hit weight loss drug Wegovy directly to U.S. patients at a discount. Drug maker launching NovoCare Pharmacy today. It says it's going to provide all doses of Wegovy at a reduced cost of $499 a month to cash-paying patients. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live here at the Bloomberg Invest 2025 conference. We're down here in Lower Manhattan. Got some of the leaders of global Wall Street gathering here for a lot of great panels, a lot of great interviews, and we're grabbing some of these newsmakers and having some good content for ourselves here. So we're having a good couple of days down here in Lower Manhattan. Let's take a look at these markets. We'll go to Vince Signorella. He does this stuff for a living. Vince, how do you take into account when you talk to traders about, I think there are tariffs, maybe some of the tariffs are coming off? That makes it awful hard to gauge, I don't know, economic growth, inflation, that kind of thing. How do the traders react?
They're just, they're dancing to the music. And there's a lot of volatility this morning. We've been back and forth in the S&P. I honestly don't remember how many times. It's been a super, super busy day across risk assets. We've had gold sell off aggressively, now back in the green. Silver's at the highs of the day. German bonds are just getting slapped on the increase in defense spending. Their biggest move, I think, ever in the 10-year, something over 25 basis points. And it's good, fun volatility. It's great for traders. I mean, you need this to make money. But it's all over the place, and there's just nothing to get a handle on. You know, comments from Lutnick this morning about trade were this kind of maybe he'll walk back the tariffs. And then you got Navarro coming out later talking really strongly that, you know, tariffs probably aren't going to come off. So that's probably put us back in the red on the S&P. And again, the music won't stop.
So where do you think we're going to wind up seeing the continued volatility? Like where, in what asset? Is it going to be in FX? Is it going to be in bonds? Is it going to be in the equity market?
I think in a lot of places. I think one of the things you're going to see is definitely in FX. We've seen a bit of a break in the correlation between falling real yields and the dollar. And I think the dollar needs to catch up to that correlation. So I'm looking for the dollar to weaken. And I think that's potentially going to be the trends for the rest of the year. In terms of bonds, it's going to be probably not as much because interest rates aren't really going to know what to do. You get that crossroads of slower economic growth potentially with tariffs, but again, the inflation underlying scenario with that. So which way does that go? And I think the volatility is going to definitely be in equities. You know, given the tariff situation, we're going to see what earnings produce. And if we see inflation, obviously not good for risk assets, especially stocks. So it's going to be all across the board, but I think in different, varying differently from asset to asset.
So how do you believe the Fed will just kind of view this news that's going on out there and as it relates to tariffs and the impact potentially on growth, potentially on inflation?
Yeah, puts the Fed in a bit of a box. I think they stand pat, you know, hands in pockets, watching to see how this plays out. There's no real yet feel. I mean, it's outside of the Atlanta Fed, which is predicting a drop of about 2.5% in GDP growth for the first quarter. We haven't seen any real hard evidence that things are really coming to a halt. But if we do, you know, that puts the Fed in a situation where they should cut interest rates because growth is slowing. But at the same time, if they see inflation sticky and coming back up, that's a bigger fear of the Fed. And you put them in that stagflation scenario, if you will, and that's a Fed that really isn't sure what to do, to be honest.
All right, Vince, we appreciate you. Thank you very much. Vince Signorella, Bloomberg macro strategist, joining us there. We want to take you to a panel now in progress with Joseph Bay, co-CEO at KKR, and Shalai Bassick, anchor and global financial correspondent for Bloomberg.
Impact from your seat.
Sure. I think it's obvious to everybody that we're in an environment right now where there's a lot of uncertainty around trade, tariffs, but it's not necessarily new. Even with the first Trump administration, he was focused on tariffs and trade. Biden kept most of those tariffs in place. So I think in our business, you know, we're very long-term investors. We need to be thinking about these issues over time, not just in one administration. And what I'd say is, you know, we have teams at KKR who focus on all these areas of macro risk, whether that's currency risk, tariff and trade, geopolitical risk, regulatory risk, in each of the different markets that we're investing in. I think this issue around supply chain security and resiliency, which relates to tariffs, is obviously front and center for all long-term investors. But people are trying to parse through what this all means. The final policies are not in place. The actions of other countries and governments in reaction to what Trump may or may not do is still unknown. So it's very fluid at the moment. And I think that's obviously creating some uncertainty and volatility.
You know, it's interesting. In conversation with you, you had mentioned that this was a risk that you should have seen coming in a lot of ways. So from where I'm sitting, it looks like KKR has been preparing for this in a way that many investors have kind of very obviously have not been. So what have you been doing to prepare for all of this uncertainty, knowing that there's even more of it ahead?
Yeah, so I think, we have over 150 companies in our private equity portfolio around the world. So again, supply chain resiliency, multiple sourcing avenues for our companies has always been a part of the risk mitigation approach. And we've spent a lot of time really over the last 5, 6, 7 years understanding that risk and mitigating that risk. And when it comes to new investments, I think a big part of our job thematically is understanding the risk environment we're in and choosing those themes and sectors and opportunities that really have less exposure to tariff risk or trade risk. So maybe a couple of examples of that is, healthcare services are very domestic, whether it's in the US, Europe, or Asia. That's an area where we feel like the tariff risk, at least, is not a pronounced risk. You could look at certain services businesses. We've made a number of investments in companies like home services, foundation inspection, maintenance companies in the US for an aging housing stock. You look at IT services and software investments in different countries. Again, very little tariff risk. So you're able to really zero in and target those industries and sectors where you don't think this is going to be a big problem.
When you think about the ripple effects that you might see from the tariff strategy, there are a lot of concerns about inflation,
Sure.
growth. How are you thinking about the economic headwinds that the U.S. is facing?
Listen, I think that's one of the big uncertainties out there that people are trying to figure out. Tariffs are inflationary by design. So I think if that leads to an escalated level of inflation in the U.S. economy, obviously that's going to slow GDP growth. It may put some pressure on the Fed, obviously, in a more tough economic environment to lower rates faster over time. But, we've always felt the bigger trends happening in the world, whether that's energy transition, the massive investments into data, a lot of these things are inflationary by its nature, putting aside tariffs, right? So we have a higher resting heart rate for inflation globally today than we've had in the last decade.
And you expect that to continue?
And potentially even get higher inflation, right? If these tariff and these trade wars continue, it's not an unreasonable expectation that in the near term, you could see higher inflation.
Well, doesn't that mean higher rates, or do you think that the Fed is going to have to lower rates into the face of that? People are starting to use the word stagflation an awful lot these days.
I think it's going to be different in different markets, and I think the Fed's going to have to be very nimble in how they navigate this risk. Obviously, if the U.S. is headed towards an economic downturn, cutting rates is probably going to be the policy response. If rates are high and we're not headed down that recession path or deceleration of growth path, then rates could actually go a little bit higher in the near term.
So let's look at this from a global perspective as well. I think one unique view you can bring from KKR is that you are very global in nature, so you see the way that the changes are happening in the tariff strategy, the way that nations are kind of separating in their relationship to each other. You see that on the ground through your portfolio companies.
Yeah.
What are then other areas of the world that are maybe even more attractive to you than the United States right now?
Well, I think it's not a secret. You had it up on the slide. We're big fans right now of Japan. We think that is a really, really underpenetrated opportunity, especially among U.S. investors. They really haven't figured out how to get the exposure they want in a market like Japan, where they're coming out of 2.5 decades of deflation. So finally, positive wage growth, pricing power, inflation is very modest, but positive inflation right now, and rates are actually increasing modestly in Japan. That's a completely different macro picture than what we've seen in Japan for the last 3 decades. And a really exciting time when you marry that with shareholder reform, activism, corporate governance reform in that market. Outside of the United States today, Japan is the largest destination of our capital.
So it's interesting. In addition to Japan, KKR has maintained a commitment to China as well. In fact, there are big deals that are in the market that KKR may be involved with at this very moment. So a lot of other investors are very worried about China, the internal economics and the relationship that China has to the United States.
Yeah.
How do you view that dynamic?
Yeah, listen, I think the geopolitical tensions right now obviously are front and center for us as we think about where to invest and how to invest. And in China in particular, you have to avoid those sectors that have sensitivity on both sides of the ocean, both the US government and the Chinese government. So we have not invested in some of these sensitive sectors like electric vehicles or semiconductors or AI. That's not the focus of our China investment strategy. We're really focusing on super high quality domestic businesses that are around domestic consumption and services. So in our portfolio today, we have one of the largest, or the largest Chinese pet food company. Again, geopolitically not sensitive. We own one of the largest pharmacy chains in China. We own the largest white mushroom grower in China, all geared towards the domestic market, a growing middle class who wants higher quality goods and services and food. You know, and I think that's the sweet spot of where we're focused in the market today.
Now, that's interesting because even if you're focused on the Chinese consumer, that might be a little more insulated to, let's say, the global macro challenges. There are a lot of concerns about the Chinese economy.
Yeah.
Why are you seeing through them?
Yeah, listen, I think the overall long-term trend in China is the middle class is growing. And the expectations of the middle class are really for higher quality goods and services. Safer food, safer services, and that's what these companies that we're investing behind are really catering towards. No doubt the macro growth in China has slowed from a decade ago, right? You were talking about a country growing at double digits GDP. They're targeting 4 to 5% growth today, right? So there has been a slowdown. There's clearly challenges in terms of the real estate market in China, and you have to factor all that in terms of the growth rate you're underwriting and largely the entry multiple. You know, the Chinese stock market today is one of the most interesting value markets in the world in terms of the multiples. So if you know what you're looking for, the type of risk you're trying to mitigate against, you could still find some interesting opportunities.
You know, yesterday I asked the question, is American exceptionalism dead? In addition to that, I ask you, is globalization a diversification play? Is it a safety trade? How do you think about it?
Well, we are a very, very global firm, and we have a lot of different ways to participate in those opportunities. Private equity, real estate, private credit, and infrastructure. So in really volatile periods like we're in right now, having that flexibility of capital, we could partner with companies, management teams, as a provider of anything from senior investment grade debt, right, to non-investment grade debt, to structured credit solutions, structured equity solutions, growth equity capital, to buyout capital. So, you know, today it's an interesting market. When volatility spikes, that usually leads to really, really interesting deployment opportunities for our firm. You need to be nimble. You need to have the local reach in all these different markets. But we're excited, quite frankly, about 2025. There are going to be hiccups. There's going to be some headwinds in terms of some of these macro policies. But our ability to deploy scaled capital around the world, we think is quite high.
I will still ask you, if not dead, then is American exceptionalism then overblown?
No, listen, I think this notion that the U.S. is going to win alone has never been the case. I think the strength of the United States is really the resiliency of the economy, the strength of our capital markets to mobilize capital to support companies in the private sector, and labor productivity, right? When you think about why the U.S. has grown faster than Europe or faster than Japan, it's really about labor productivity in the United States. A lot of that is technology-driven and innovation-driven, but a lot of that is our unique mobility of labor in this country, right? You think about Japan, which is going through this resurgence. You know, structurally, they've done the best job of any country in terms of women participation in the workforce, people working longer in Japan, right? They've got real demographic challenges. They've done an excellent job around automation and robotics in their industrial base. But they're not getting the labor productivity because the mobility of labor in Japan is quite constrained. And their investment in software and tech is a fraction of what you see in the United States, right? So the real superpower of the United States is labor productivity at the end of the day.
I do want to spend the remaining time here switching gears, talking about the future of KKR, because it's been fascinating to watch the change from an iconic private equity company to what you are today. There was the full acquisition of your insurance company last year, Global Atlantic, and it's made KKR look more and more like Berkshire Hathaway. And there's one part of your business that's far less understood that I think makes you look like the most like Berkshire Hathaway, and that's your strategic holdings business. Many people don't know that KKR owns 18 companies on your own balance sheet at KKR. What is this business going to be in maybe 10 years, and why is it valuable to you?
Sure. So when you think about KKR as a business, we really have three core strategic parts of our business strategy. Asset management, I think, is well understood. It's what we're known for the last 50 years. So that's our third-party private equity, again, real estate and infrastructure, private credit business. And that's a $650 billion business that you mentioned at the start. The second big pillar of our business today is Global Atlantic. It's a 100% owned insurance company in the life and annuity space, roughly $190 billion of AUM there. And again, playing into all of these trends around retirement savings, retirement security, and being able to offer individuals compelling products for their own long-term savings. The third piece of it is a segment that we introduced last year at our Investor Day, but it's been a segment we've been incubating for well over a decade now at KKR, and that's strategic holdings. So what we're trying to build in strategic holdings is, in some ways, a mini Berkshire Hathaway, right? These are companies where we own large stakes, sometimes controlling stakes, sometimes not, but businesses that we think we could own literally forever, businesses that have the potential to compound in mid-teens over a very, very long period of time, very defensive in nature. So we have 18 companies in that portfolio today. We're going to continue to redeploy our free cash flow at KKR to invest in more of these types of businesses. And it's not just private equity. Over time, it's going to include certain platforms, probably in infrastructure and real assets, maybe certain buildups, that we're going to do in different sectors. When Scott Nuttall and I, my co-CEO, joined KKR back in 1996, Berkshire Hathaway had a market cap of $40 billion and roughly an NAV balance sheet of $40 billion. You fast forward 28 years, they have $1 trillion market cap on the back of long-term compounding of their balance sheet and their investments, right? Some version of that is what we're going to be doing with strategic holdings, but leveraging all of the skills and expertise we have in our private equity teams, our infrastructure teams around the world.
So what's an interesting parallel here? If you think about Berkshire Hathaway, is it almost like Global Atlantic is your own Geico, and these future infrastructure holdings will be your BNSF, and your private equity holdings would be kind of like your stock portfolio?
Yes, it's an imperfect analogy, but directionally you are absolutely right. I think, listen, strategic holdings for us, you got to think about it as a way, how do we think about redeploying our free cash flow as a business back into the most attractive areas? Some of that might be in our traditional, third-party asset management business, right? If we find great ways to deploy capital across those investments, we'll deploy that capital. A lot of the capital is reinvested back into Global Atlantic. We acquired our first controlling stake in Global Atlantic in 2020, and GA at that time had around $70 billion of AUM. 4 years later, it has $190 billion of AUM. So we've supported that growth with more investment. And then this third segment of strategic holdings, obviously, which is what we're super excited about, is one where we're going to be continuing to invest a lot more of our free cash flow as a business. So our guidance to the street today is by 2026, that portfolio will be generating around $350+ million of after-tax dividends for us. That's growing to $700 million by 2028 and $1.1 billion by 2030. So it is a very, very visible, recurring, growing cash flow stream at KKR.
So you essentially have a kind of a future unicorn of sorts being built inside of KKR. If you're going to be bringing in $1 billion over time in this business, do you think it's built into KKR's stock, that assumption yet?
I think people are starting to appreciate what we're trying to build. But I think the bigger picture is when you look at our universe in the alt space, 5 years from now, 10 years from now, I think many of the public peers in this sector are going to actually take very different approaches to how do they grow their firms. I think the approach we have with third-party asset management, insurance, and strategic holdings is quite differentiated and different than the way most of our peers are trying to grow their firms today.
Now, I want to spend a little time talking about not just institutional capital and how you are deploying capital in your own balance sheet. We've been talking so much about how there's been a massive push for retail when it comes to the world of private assets. Everyone is doing it differently. You have a relationship with Capital Group in order to make this available in a mutual fund form. So how available is it to invest in private assets from where you're sitting? What's the minimum amount you would need to put into a fund to start to get access to what you're offering?
Sure. So the way to think about the bigger picture opportunity is, you know, for most of our history at KKR, we were founded in 1976. Our core client base was really large institutional investors, pension funds, insurance companies, sovereign wealth funds around the world. The individual investors who participated with us were really ultra high net worth families and family offices who could allocate capital as part of their diversification as really LPs in our funds. They were sophisticated investors willing to take that 10 or 12 year, you know, illiquidity risk, just like a pension fund would. So that's a very small percent of the households, obviously, in the United States, but that's how they've accessed and partnered with us historically. What's relatively new for us in the last 2 to 3 years is we've introduced a series of private wealth products for individual investors who are accredited investors. Okay, so those are investors with a net worth of, call it $1 to $5 million. These open-ended evergreen products have semi-liquidity features, so you're not locking up your capital for 10 to 12 years. You have the ability, if you need it, to redeem a portion of your capital every quarter. So it's a slightly different format, but it's investing in exactly the same deals that our flagship funds are investing in, right? So we're trying to deliver that same institutional quality experience, the same portfolio, the same access to deal flow, whether that's in private equity, real estate, infrastructure, or private credit, to individual accredited investors, right, in that $1 to $5 million in net worth. That's around 10% of the households in the United States in those first two buckets, ultra high net worth and accredited investors, and roughly half the AUM in the individual channel. With Capital Group, we have an exciting new partnership, which really addresses the next 90% of US households. These are mass affluent individual investors who probably wouldn't be buying our private wealth product and wouldn't be LPs in our traditional fund. So we're creating hybrid products with Capital Group in a mutual fund format. We're starting with credit in the second quarter, where we're going to be putting a portfolio together where Capital Group manages the public credit. We will manage the private credit allocation in that mutual fund and deliver a product to the mass affluent that looks very different from anything they've been able to buy before.
You know, it feels like the holy...
All right, that was Joseph Bay. He's co-CEO of KKR, speaking with our own Sonali Basak, anchor and a global finance correspondent here at the Bloomberg Invest 2025 conference. A lot of great speakers here. Let's get a reset here. We're going to come back with a guest, but let's go to John Tucker and get a Bloomberg Business Flash. John, what do you got for us?
Kind of all over the place today. The major averages right now are lower. The S&P 500 down 23 points, a decline of 0.4%. We're at 57.54 in the index. The Dow Jones Industrial Average 63 points lower, and the NASDAQ 100 right now 116 points lower. That's down 0.6%. As I say, volatility, the watchword of the day. The VIX, the Wall Street fear gauge, elevated right now over 24. Did get the data today. Service providers expanding in February at a faster pace. Separate figures out earlier from ADP showed the smallest advance in private sector payroll since July, with job cuts in the services sector. And as for treasuries, the 2-year yield 6 basis points lower, right now at 3.92. The 10-year yield 1 basis point lower, and that's at 4.22. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, JT. Alex Steele here alongside Paul Sweeney at the Bloomberg Invest Conference 2025 downtown in Lower Manhattan. Now, obviously, when you get together wealth managers, private equity, bankers, private credit guys, they're all talking about alternative assets. But what if you've already been in that space for decades. What do you do there? Well, joining us now is Purnima Puri. She's governing partner and portfolio manager for public credit at HPS Investment Partners, which was founded back in 2007 to focus on credit and, guess what, longer dated, less liquid investment opportunities, which it feels like that's the world that everyone's chasing right now. You guys ended 2024 with $149 billion in assets under management. Where are your biggest opportunities?
Yeah, so when we started the business, the regulatory environment changed pretty quickly thereafter, and it really gave us the opportunity to get involved in the private credit business. And at the time, private credit was more levered companies in the high yield market or a substitute for broadly syndicated loans.
Like I can't get funding from my regular bank, so I got to go to you and pay up.
And there were moments of dislocation in the marketplace, and so the banks might not have been there at that moment in time. Regulatory environment changed, and that opened up the sort of, I'd say that opened up the marketplace for people to be an alternate provider of capital to companies that needed it at different moments in time. And so what we used to be, was when the capital markets were shifting, it actually transitioned a lot. Like our business, for example, we invest not just in sponsor deals. We provide capital to owners as well on a regular basis. So over time, the market's evolved a lot. I would say the market is really bifurcated. There's a whole host of folks in private credit. You said it yourself, there's been a ton of funds that have been raised. We tend to traffic in, I would say, number one, bigger businesses. Number two, we tend to provide larger sources of capital. Three, we have flexible capital in terms of top and bottom of the structure. So we are able to sort of think about where a solution might make sense for a company. So that competitive landscape, I think, is a little bit smaller in terms of the folks that are trafficking there. The other thing I would say is private credit's expanding dramatically now because you're seeing it with, I think Joe Bay was just speaking, private IG, that's a whole nother sector that there's a whole need of financing for all these mega trends that are happening in the U.S. So that could be infrastructure, that could be AI, that could be energy transition. And that opportunity set is sort of ripe for folks like ourselves and others to take advantage of.
What's a typical deal size for you guys, and how has that changed over the years?
Well, it's changed a lot because the market's changed a lot. So several years ago, you did not have a lot of private credit tranches that were, call it much greater than $300 million in size. There are many now. I'll give you an example. In the marketplace today, there are 3 deals I can think of that are refinancing in the broadly syndicated loan private credit. One of them is a $4 to $5 billion deal size. That's one tranche. Another is, $3 billion on the first lien, $900 million second lien. That's a tranche, and another is $2.5 billion. So now you're starting to see $1 billion deals. Wow. You don't have tons of people that can traffic in $2.5 billion deal sizes, but there's guys out there that can. We think there's 5 or 6 people who do that on a regular basis every single day. But that's a smaller pool of competition, I think.
Are you seeing the distressed market grow, pick up? Is it the catastrophe we all thought it was going to be 5 years ago, or no?
I mean, I would say no. I don't think this was like the default cycle that never was.
Yeah.
So it was a variant on the distress cycle, which is, you guys have talked about this, I'm sure, but all the liability management stuff and sort of structured transactions to kick the can a little bit and figure out if you had time, especially in the world of rising interest rates where balance sheets got stressed. But we haven't really seen a distress cycle. And in fact, if you talk to my partners who run our private credit business, they would say they were surprised by how well a lot of companies did over this period of time.
I started my career at the Chase Manhattan Bank in the leverage lending group, lending 5-6 times net debt to EBITDA. We took a big fee up front. We syndicated all the risk off our balance sheet. It was a great business. I would never allow you to come in and take one of my clients. What are the banks doing here? Why are they letting this business go to people like you and others?
Oh, my gosh. Wow. So one is that there's a regulatory environment shift, right? That changed a lot from when you started and, frankly, when I started and all that kind of stuff. So that's number one. Number two, there's different reasons companies go to private credit lenders, right? Because banks, by and large, just take the broadly syndicated loan market, right? That broadly syndicated loan market is 60+% CLOs. CLOs like a box. There's a box. You want a rating. You want a certain amount of leverage. You need a certain amount of diversity. It's great business, by the way. But the things that are straight down the fairway nicely fit into a CLO. So all of a sudden, if your rating's constrained and maybe something's B minus, that market may or may not be available to you at a given moment in time. So why do issuers go to private credit, folks? Well, they'll go because maybe they need flexibility in picking for a period of time. Okay, that could be one. Maybe it's because the market feels pretty saturated in particular industries. That could be two. Maybe it's because people need a delayed draw facility because businesses aren't static and they grow over time, and you want to have that funding sort of lined up and ready to roll if it's a roll-up or something like that, or you have a CapEx plan or something like that. So that could be the third reason. And then four, I think that, what we've seen certainly in some of our buckets of capital is that as businesses grow, sometimes they like to have one or two relationship providers.
Interesting. It's great business.
What do you not want to touch right now with a 10-foot pole?
Well, I think I'm sure you've heard this from everybody. We don't know what's going on with tariffs, and tariffs have both short-term implications and longer-term implications. The longer-term implications are trickier to underwrite because trade wars are very difficult to underwrite, and that coupled with the other sort of things as part of the puzzle, immigration, slower growth, et cetera, but it will affect everyone's portfolio, everybody's portfolio, every company. Shorter term, maybe there's a band you can't underwrite on tariffs. So there's sort of the obvious, which are, industrial manufacturing, retailers, certain things in the consumer space, which get trickier to underwrite.
But just real quickly, 30 seconds, your market is open today. There's 3 deals in the market.
The broadly syndicated liquid loan market is open, yes. There's been $160 billion of CLO growth demand, and the market since 2021, the levered loan market has changed by $50 billion. Wow. There is a lot of people who want paper.
Yep, there you go.
All right, really great to get your perspective. Purnima Puri joining us from HPS Investment Partners, also fellow Northwestern grad. And now you're rubbing off on me.
They are
I
good.
also know
They are
it's
good.
Northwestern. It was really cold. It was very cold.
It's supposed to be. It's Chicago.
Yeah, but it's because you're not you don't have big towers because you're kind of
a lot
out
of wind.
Chicago.
A lot of wind.
So all you have
You
is
got the
that
lake,
wind.
though.
Yes, and it's cold.
Yeah, all right.
Yeah,
I went to Virginia and North Carolina. I'm not
So
dealing
many
with that stuff.
layers. All right. Thank you very much. We really appreciate it. It was great to talk to you. We're going to have much more coming up on Bloomberg Intelligence. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, will be joining us to break down the State of the Union there. Plus, we'll wrap everything up here with Steve Meyer, New York City Retirement Systems Asset Management CIO and Deputy Comptroller. Again, what do you do with market volatility and interest rates that may stay sticky for longer? And maybe we'll have more inflation as well. And how do you manage that in that environment? This is Bloomberg Intelligence on Bloomberg Radio. Looking at the markets, I gotta say, equity market going nowhere fast. We are now down a little bit here, though. S&P down 0.5%. Volume very light.